What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
If somebody said, I want to be the next Reid Hoffman, what would you say is the best training ground to do that?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself.
The growth story in cannabis remains very strong, even after the sort of the loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
So, folks, we got to listen to the scientists and the economists and the national security experts. They all tell us this is code red. The nation and the world are in peril. That's not hyperbole. That is a fact.
The President of the United States on climate change, speaking in Queens, New York. From New York City this morning, good morning. Alongside Lisa Bravitz and Kenny Lyons, I'm Jonathan Ferro. Tom Keene back with us tomorrow. Here's the price action this Wednesday morning. Equity futures down 5. We're negative a little more than 0.1%. The bond market is bid this morning. It wasn't yesterday. Yields are in a couple of basis points to 135.12. Lisa went through the supply. A little bit later, we get 10s. Tomorrow, we get 30s. This is what I want to talk about briefly, though. We'll talk about this a whole lot more through the day on Bloomberg TV and radio. Evergrande, the stock, very briefly through the IPO price way back in 2009. Over in Hong Kong, closing positive today by almost 4 percentage points. But Katie Lyons, it's that little break at 350 very early in the session that got a lot of attention.
Yeah, all the way down to 347. And that was after the second downgrade, ratings downgrade in 2 days. First it was Moody's, now it was Fitch saying that there's a probable default here and that as a result, they had to cut the rating even further into junk. And John, the question here isn't just in terms of Evergrande, which is the world's most indebted property developer, but the ripple effects, the potential contagion effects elsewhere in the property sector in China. This is a story that probably is not going to go anywhere anytime soon.
That tension, not just in the stock, very much in the bond. Lisa, we can talk about that now. The debt profile of this property developer, a report that came out literally a couple of hours ago suggesting that Evergrande plans to suspend interest payments on loans from 2 banks due September 21st. You're starting to see the dominoes fall here.
Yeah, and just to sort of add on to what Kaylee was talking about, the most indebted property developer, it has more than $300 billion in liabilities to other borrowers, including shadow banks in the Chinese system, just to give you a sense of the potential ripples that she's talking about. But the issue is not debt maturities. It's just the simple interest payments that they're going to struggle to make, and that's what we're seeing this morning, John.
So, Lisa, right now, let's talk about contagion risks. Through credit in China, high yield clear. Outside of that,
honestly, who has gone into China to buy the securities, right? Do we have visibility into who has gone in the search for yield? I mean, we saw with the Archegos how interconnected some of these things were. Is there a big Chinese owner that's going to have to liquidate other assets? Yeah. I mean, these are the types of nodes of contagion that we've got to look out for.
And Curran's going to join us in the next hour on this. I'm looking forward to that conversation. I'm sure you guys are too. Joining us down in D.C., I'm pleased to say, is Emily Wilkins, our Bloomberg government reporter. Emily, Politico just publishing moments ago, talking about the Senate bias of this administration. Does any of that matter right now, Emily?
It does a little bit, because you have to have the House to pass legislation as well. And frankly, to a certain extent, President Biden is risking angering certain members of the House who feel like they haven't had their say in these major infrastructure and reconciliation bills. I mean, you saw Chairman of the House Transportation Committee, Pete DeFazio. He was very upset when the Biden administration primarily worked with senators to get that infrastructure passed, saying there were House-passed priorities that were not a part of that bill. And And now you're seeing lawmakers in the House vow that that will not be the case with this upcoming $3.5 trillion or however many $1 trillion reconciliation package that's being worked on. I mean, members of the House, they're also elected officials. They want to make sure that their ideas and their policies are also being a part of the conversation, and that this isn't simply a bill that's being developed between the Democratic senators and President Joe Biden.
Emily, I haven't heard about Joe Manchin recently. What's he up to these days?
Well, Joe Manchin definitely came out with that big op-ed the other week, really advocating for far less than the $3.5 trillion.
So after that, has he just been basically put in a closet and everybody just screams at him until he comes on board with a certain headline number?
I don't think the negotiations in the Senate are quite that tough. I mean, look, right now you're seeing lawmakers working behind the scenes. They're putting together the details of this reconciliation package. Remember, they've got each committee sort of working on their own little piece right now. We're beginning to see some details from those pieces that will come in the next weeks as committees pass these more detailed outlooks at exactly what these policies are going to contain, and with the goal, of course, of getting this done by the end of the month.
Well, and Axios reporting this morning, Emily, that Joe Manchin doesn't want to spend any more than $1.5 trillion on socially oriented programs. If we're looking at spending $2 trillion fewer dollars, what does that mean for the pay-fors and the tax implications?
That's a really great question. And I think a lot of this comes down to what Joe Manchin wants versus what progressives want, trying to strike that balance in between to make sure that all Democrats really remain on board throughout this process. I mean, White House advisor Ron Klain said that, the White House is in conversation with Manchin, that they are talking with him about what he wants to see in the bill. I think another big question right now, I know that we're looking at the top line number. That's obviously important. But I think the other big question is how much of this bill winds up being paid for? What kind of taxes can they get in there to raise revenue for the government? And how much is that going to offset the social programs? That's certainly something that Senator Manchin has highlighted that is important to him in the past. It's something we've heard from other moderate Democrats that is important to them. And that's what I'm going to be keeping my eye on in these next several weeks. How much of this overall bill is paid for? And does the bill being paid for allow moderates to feel a little more comfortable with a higher spending number?
Emily, thank you. Emily Wilkins down in Washington, D.C., our Bloomberg government reporter. And let's go back to where we were at the top of the program. We were talking about that downgrade from Morgan Stanley and Andrew Sheets going underweight U.S. equities. And here was the line, Lisa. The next 2 months carry an outside risk to growth policy and the legislative agenda.
Yeah, and the agenda isn't just passing the plan, but also what if they pass it and then with higher taxes? I mean, is the net benefit more of a negative when it comes to equities, John? And I think that increasingly the conversation is moving toward that.
21 to 25, anything to worry about as opposed to 21 to 28?
I think that people are looking at how they plan to crack down, right? Because we have certainly a headline rate now that a lot of companies don't pay, right? So how do they implement this? And then what are the offsets? If you get a $1.5 trillion bill spread out over 8 years, and then you end up with a 25% corporate tax rate, that might have more of a drag than it does a benefit, certainly for certain companies.
What do you make of that, Kelly? An outside risk to growth and to policy too?
Well, I think we have to consider that this isn't just about the trillions of dollars in socially oriented spending, because the House has been very clear that they won't pass the bipartisan hard infrastructure package until there is an action on the social oriented spending. And that's where they're really focused, the things like climate and childcare. And you have to consider the economic implications of what has already been baked in terms of having that harder infrastructure spending. It could be that both things collapse, and then that would have some pretty major implications for the market and the economy.
One of the implications is that Lisa might lock you in a closet in the Senate.
Okay.
What was that about?
Well, I'm just trying to figure out.
You're just going to throw Senator Manchin into a closet and lock him in there down in Washington.
Trying to do that. Look, I'm just trying to understand what the negotiation tactics really are. I mean, how do you negotiate with someone who says that,
Leader Schumer doing anything like that?
Okay.
To anyone down in D.C.
Wow. You really want to wind me up today, don't you, John? You're trying everything you possibly can. I think you just succeeded. Look, I think that this is an important point. Joe Manchin represents a number of moderates here, and they need to come on board with something that is really unpalatable for their constituents. It's not even just them, it's their constituents. They can't go back and say they signed off on this plan. And so how do they make it palatable at a time when we kind of still need some fiscal impulse?
I'm just lashing out. Maybe I missed Tom a little bit.
You're lashing out.
Maybe baby, like a child. We're down 5 on the S&P. We're negative
punching bag.
a little more than 1/10%. It's not you, Lisa. You know it's not. In the bond market, yields are lower by a couple of basis points on 10s to 134.95. It's a little break at 135. From New York, on radio, on TV, for our audience worldwide, this is Bloomberg Surveillance.
What do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City for our audience worldwide on TV and radio. Here's the price action this Wednesday morning. Good morning. Equity futures down about 5. Negative a little more than 1/10% on the S&P. The Nasdaq 100 all-time highs at a close yesterday. We're down there by almost 1/10 as well. A similar move on the Russell. The Russell, the small caps, had a real struggle in yesterday's session. Looking elsewhere, underweight over at Morgan Stanley, the call there for equities here in the United States, but maintaining a view, a constructive view on Europe and Japan. I'm reminded of something Rick Reeder of BlackRock said to me a number of years ago. We're always focused on the shark closest to the boat, and the shark closest to the boat right now is everything US-centric. Look at what's happening abroad at the moment. Let's look at this one single name, Evergrande, the Chinese property developer. A break of 350, a little bit early this morning. Why does 350 matter? It was the IPO price all the way back in 2009. On the session, actually closing positive, up by some 4 percentage points. But this stock is all over the place now. It's the bonds you want to watch. And there's a report this morning suggesting that that company will have to avoid the loan repayments on September 21st to a couple of banks. That's something to keep an eye out for. And the story is something to keep an eye out for, because this is clearly starting to bleed through high yield in China. The question we've got to ask, does it bleed elsewhere into the rest of the world? So far, so good, but that's the focus for me, for Lisa, for Kaylee, and for others too this morning. Let's finish on this then in the bond market. A curious story with the NASDAQ at a record high and a bond market that was actually selling off and not rallying. What's going on? Yields higher Friday, higher Tuesday, this morning lower, down by 2 basis points. A break at 135 at 134.95. Hard to get a read on this bond market this morning, Lisa. In fact, over the last week, we've got a ton of supply on the sovereign side and also a ton of supply as well on the credit side as well, the corporate side, just really building up through the week.
Yeah, record number of issuers yesterday. And you do have to wonder why there is still so much demand, even as we're talking about taper, both in the U.S. as well as in Europe. Do you think that the ECB is going to go there?
The ECB tomorrow. I've got to say, you know what, Lisa? For the first time in a long time, I'm actually looking forward to the ECB tomorrow.
All right, let's screenshot this.
I've been let down so many times by that news conference. Literally every single time we have a news conference with the ECB, it ends, and at 9:30, I'm slightly embarrassed that we stuck with it for so long. And I'm hoping that maybe tomorrow's going to be a little bit different.
We all hope that, John. Thank you so much. I want to go back to what you were talking about earlier with Morgan Stanley, Citigroup, and Credit Suisse all coming out and downgrading their expectations for U.S. equities. They're not alone. They see a slower growth trajectory. And the question is it a big, broad downdraft, or is it a more specific sell-off in specific stocks? Someone who's been tracking this and, frankly, seems to agree somewhat with Morgan Stanley and Credit Suisse is Jose Roscoe, HSBC Private Banking and Wealth Management Chief Investment Officer for the Americas. So, Jose, what's your sense? You just recently actually did get a little more cautious. Can you give us a sense of what was behind your view and what triggered the change?
Well, it was several things, Lisa. Good morning, first of all. And I think if you look, you see the Delta variant has had an effect on growth, and we think that is going to continue to play out over the coming months, even though it seems like it's peaked. Secondly, you've seen that the labor markets remain somewhat unglued in terms of the demand for labor seems to be far outstripping the supply. And so we have those factors that have to be, taken into account. In addition, we're heading into September is usually a tough month for equities. And as a result, we think that's going to play out this year as well. You talked earlier in the show about some of the budget woes, the debt ceiling, and what's going to happen with the $3.5 trillion spending plan from the Biden administration. All those things we feel are going to factor in. The one thing we're more sanguine about than others, perhaps, is we remain convinced that the story is going to flip in terms of profitability and inflation, where rather than talking about slowing profitability and accelerating inflation, as we head toward year end, we think that story is going to begin to reverse a bit.
All right, so Jose, it sounds like you're getting a shopping list together and you're keeping perhaps a little more cash or at least some more stable equities that you can sell and then go right back into the riskier bets. Am I correct here?
Well, what we did, we actually increased our weighting in Europe, where we think there's some upside momentum still to those markets. So from a valuation perspective, they still look very attractive, right? You've got dividend yields that look attractive. And more importantly, as global growth continues to improve, albeit more slowly, European exporters look pretty good from our perspective. And therefore, that was somewhere we wanted to, churn a bit for a few months at least.
What's the thesis behind seeking more cyclicality perhaps in Europe, but reducing some cyclicality within your U.S. equity exposure when it comes to the likes of industrials and energy?
Well, part of it was the story of valuations, which in the U.S. have gotten a little rich. We still think that resolves itself over the coming months and quarters, as we think earnings are going to look better than people think, and inflation is going to slow more precipitously than people think. But for now, that was part of the reason. Remember, as you head toward the fourth quarter, the S&P has returned over the last 25 years about a little more than 10% in total return basis, and 5.3% of that 10%, more than half, has come in the fourth quarter. Now, we also see a lot of volatility in the third and fourth quarter relative to the first half of the year, but we expect those returns to improve. So we'll probably be reversing that as we head toward year end. And as you mentioned, will we be facing a new tax regime next year? Some of those questions yet to be resolved, but as we head toward the end of the year, we think a lot of companies are going to pull forward a lot of their investment plans and a lot of other things that could help lift markets as well here in the U.S.
So what assumptions are you making about the bond market and the trajectory of yields when thinking about your equity allocation?
Yeah, it's such an important variable, obviously, and clearly with, still I think it's like $13 trillion worth of sovereign debt that's underwater, right, that yields less than zero, and negative yielding sovereign debt. And as a result, any tick up in U.S. Treasuries is usually met with some pretty good demand. So that's one thing that we're factoring in heavily, is that we think there is somewhat of an upper limit to what yields can do on the 10-year for the U.S. sovereign market. In addition, keep in mind, next year's deficit is probably going to be a third of what this year's is, right? So we should see less issuance, and this is something you just alluded to, less issuance going forward relative to what we've been used to in the last 12 to 18 months, right? So that's something else we think will affect and keep a lid on rates.
As you look around the world to try to diversify, this is kind of sensitive for HSBC, but China has been a real hotspot recently for controversy in terms of some of the policy actions, as well as people's willingness to invest in the region. You recently moved to neutral. When did you do that, and what was the thinking?
A few months ago, and we felt that there was regulatory risk. Look, long term, I think the story in Asia, there is a short-term regulatory risk, no question about it, especially in certain sectors, excuse me, and it's affected performance. But if you look at the fundamentals of Asia remain overwhelmingly positive in the short, not so much in the short term, but in the near term and long term, for sure. It is the pillar of growth for the global economy. It is going to be the pillar of wealth creation. Technological innovation is really ramped up. So we think we're entering into what we call a virtuous cycle of infrastructure spending, lifting standards of education for workers, so more workers can be trained and put to work in these technology sectors. And they're trying to create a virtuous cycle.
I apologize to interrupt. Yeah. So you're not concerned at all by the crackdown on big tech companies that come from a more social perspective with less of an eye toward the business?
Oh, no. And that regulatory risk is something that we've adjusted for, right? That's why we went to neutral. But, in terms of the fundamentals still look good from our perspective longer term. Is there regulatory risk? Of course there is. Is there regulatory risk here for tech companies? I would argue there is as well. Maybe not as pervasive, obviously, as what we saw in the short term over there in China. But, the Biden administration has talked a lot of different issues for tech companies here, as well as in Europe. So I think big tech is under fire in many parts of the globe. It's not unique to China. So, yeah, it was a concern. We feel that it's something that's going to pass in the next couple of weeks and months, and then we can reevaluate our positioning there. But longer term, we still think Asia's a tremendous area to invest in, and led by China and India as we go forward.
Jose, good to catch up, sir. It's good to hear from you. Jose Rasca there, HSBC Private Banking and Wealth Management CIO. Let's get a check of the markets for you. Equity futures this morning down around about 4, negative 0.1% across the board here on the S&P. On the Nasdaq, we come off all-time highs from yesterday's session. Into the bond market, yields are lower by a couple of basis points to 135.12 on 10s. The euro just a little bit weaker into the ECB tomorrow. Euro dollar 118.20. We're negative 0.2%. I'm pleased to say that my good friend, my old buddy, Bloomberg's Manus Cranny, standing by in Cairo. Manus, good to hear from you, sir. And just look at that chair. If only they could see this on radio. A palatial Manus Cranny this morning.
Jonathan in New York, thank you very much for the welcome. Yes, we are in the Ministry of Foreign Affairs. At a very timely moment, we're joined by His Excellency Sama Shoukry, the Foreign Minister for Egypt. Sir, thank you for having us into your offices, a grand home. It's an interesting time in our region. Biden is delivering on Trump's plan to leave Afghanistan. That is done. What does that mean for the Middle East for you?
Well, certainly the ongoing conflict in Afghanistan and Iraq has burdened the region quite substantially over the years, and the departure, of course, from Afghanistan has its ramifications and will be followed and deliberated upon within the context of the Arab region. Tomorrow we have a meeting of the Ministerial Arab League, and that issue will be a focus of discussions between the ministers. Undoubtedly, a transformation of this nature and this magnitude will have interesting repercussions, and we await to see what those repercussions are in terms of how the new Taliban government will operate, how it will sustain the commitments that it has made, and how we can have the security and the stability of the region within the newly existing situation.
But do you see this as a disengagement by the Biden administration, making this region more unstable?
No, I don't think the United States as a superpower, as a power with both interests and very deep relationships with the countries of the Middle East, is in a position or can disengage. I think it will continue to rely on its traditional relationships and partnerships, among them with Egypt, a strategic ally, and will continue to extract its interest and also provide the security and the stability that the region needs.
My assessment as I got on the plane to come to Cairo is there is a tectonic shift in discussions between the nations here in the Middle East. Would you describe that between yourselves and Turkey, the UAE and Turkey? There is, in my mind, a tectonic shift. Do you agree?
Not necessarily. I agree that the region is undergoing a very turbulent and volatile situation where there has been, of course, conditions that have not been readily contributing to the peace and security of the region. We have conflicts in Libya, in Yemen, in, of course, the situation of terrorism and the threats, the current situation in Syria and Lebanon. These are all issues that have to be addressed, and I think it is in the best interest of the nations of the region to expand the communications and the understandings that can provide for the security and stability.
You're about to enter round 2 of discussions with Turkey, Egypt, Turkey, upgrade the bilateral relationship. What does that mean? Will you restore diplomatic ties?
Well, at this stage, this is the second round of exploratory talks between Egypt and Turkey. This comes at the invitation of the Turkish government. We have been eager to find a resolution and to find the necessary formula for regaining the normal relations between the two countries. But I think at this stage, we still have to evaluate the outcome of this second round of discussions and primarily the context of the bilateral relations. The bilateral relations and certain measures that were taken by Turkey need to be somehow addressed, and when we are satisfied that those issues have been resolved, that will open the door for further progress.
I have a lot to get through, and time, of course, is a natural enemy. But if I say to you in a succinct way, what do you need to see from the Turks to move forward to restore bilateral relations, what would that be?
We have provided Turkey with our assessment and our requirements. I think they very well comprehend and can fulfill all of these issues, and we hope that they do so that we can move forward.
On the Renaissance Dam, it's a very contentious issue, obviously, and you've tried to arbitrate with Ethiopia on several times. President Sisi has said all options are on the table, including military action. Sir, are you prepared to take military action against Ethiopia?
No, the president has never indicated that he would be taking military action, but I think the terminology has always been that for any country, all options are always open, and we have committed ourselves to the negotiating process. We have endorsed the negotiations over the last 10 years, and we have supported the negotiations of the African Union under the chairmanship of President Tshisekedi, and continue to seek an enhanced role for the observers to help the parties to find a resolution.
Will you do everything to avoid conflict?
Definitely. I think nobody seeks conflict. We have been committed over 10 years to a peaceful resolution of this issue based on international law, based on best practice. And I think we still would seek that the political will of the Ethiopian government is demonstrated by signing an agreement.
thank you very much for joining us, Foreign Minister. Thank you for the welcome to the country. I hope that we come back again. Sameh Shoukry, the Foreign Minister for Egypt, joining me. It's been a great trip, and I have got to say, when it comes to offices, sir, I think you're on a winning trade.
Happy to have you.
Thank you very much, sir. Jonathan, Lisa, good morning to New York.
Hey, Manus. Great to hear from you, sir. Thank you very much. Lisa, you know they used to separate Manus and I in the office in London.
Oh, I believe
we weren't
it.
allowed to sit next to each other for the best part of 5 years. They just have us sitting in different locations.
Wait, it's kind of a pattern. Hold on a
in the London
second.
office. Tom and I are also separated
John,
too.
there's literally
for good reason.
a glass wall between
reason.
you.
We're all friends here. We're down
COVID.
4 on the S&P. COVID,
Look
that's
there,
right.
Kaylee's over there
This
just
is
like,
COVID. That's
really?
all about COVID. We're down 1/10 of 1%.
Sure.
Is it? On the S&P 500. In the bond market, yields are in a couple of basis points to 134.95. Of course, this has nothing to do with Kaylee, Lisa and I, much more to do with the man who usually sits in that chair. In the commodity market, crude 69.27. We're up there by almost 1.33%. Lisa, did you see the piece from Lionel Laurent and Sam Fazeli in Bloomberg Opinion? COVID travel is still a mess. It shouldn't be. This is how they conclude. No relaxation of curbs, I'll get my words out, is risk-free. But this has to be balanced against the progress we've made so far in managing COVID. They go on to say, and the reward of improving mobility at this stage of the pandemic with the tools at our disposal, a shift looks worth it. Their conclusion in Bloomberg Opinion this morning.
And you can push it even further and say, if you've got these travel curbs, what are they exactly accomplishing if people already are in a nation that have the different variants and are spreading them? What are we accomplishing? What scientific basis does this have?
Let's have that conversation right now. We can do that with Dr. Bhakti Hansati, Johns Hopkins Associate Professor of Emergency Medicine. Doctor, can we start there? What we're achieving right now with some of the travel restrictions worldwide.
So travel restrictions are an essential public health strategy when it comes to mitigating transmission of the virus. Now, the challenge, and what we've seen with COVID, is that we have a global community, people travel, everything spreads very quickly. However, there is a benefit because by going on airplanes where you have a small environment with multiple people, it's really difficult to ensure that all those people are COVID-free during that flight. And so I think travel bans really right now help transmission during travel opposed to transmission from one country to another.
Dr.
And
Are
you're
they
right,
effective?
right now, US,
Do you think they're effective as they currently stand? I mean, the United States, and I've got skin in the game here, and I've been very clear about my skin in the game on this particular story, but for the Europeans that can't travel here, but if you're in Turkey, you can, if you're in Mexico, you can, and then you look at the amount of people who have been vaccinated in, say, Mexico versus Germany, it just doesn't make sense for a lot of people, Doctor.
also have skin in the game. I completely hear you.
Yeah.
It made sense. It did make sense earlier in the pandemic to give us time to prepare, to do surge preparedness, to identify testing strategies. I'm not sure if it does make sense anymore, especially when there is so much other travel happening around the world.
Well, we also have 75% of all Americans that have at least received one vaccination. At what point have we reached that threshold where we have to say, look, we're getting as close to the new normal as we are going to get. We've got to start to respond appropriately.
Absolutely. So we've talked about this on the show previously. This is not a zero-sum game. We have to minimize risk as much as possible, but we can't obliterate risk completely. And so I think we're probably, when it comes to vaccinations, we've seen a good surge recently. We're maybe as good as it's going to get.
All right. Meanwhile, John has his bone to pick with respect to travel restrictions. I have a lot of skin invested in this particular issue. There are calls growing to try to approve the vaccine for those under 12, and people saying, what is taking so long? It was supposed to be September. Now it's being pushed back to possibly even the end of the year. What's your view based on the data that they have and whether they can move ahead at a time when children look more and more exposed to a variant that's incredibly contagious, and a lot of the adults are already vaccinated?
Sure. Well, what was unsurprising to everybody was that.
Okay, guys, position opened on Bitcoin. As you can see, 45,911. Okay, well done. Speak to you later, guys.
It's time to take a pause and look at the data again, but also to increase recruitment in those trials with children of different ethnicities and races and different ages. So I think it's appropriate that we're looking for more data and taking more time to comb through the data to understand, like, what is the incidence of myocarditis or other complications, and how is that likely to affect children long term prior to approving the vaccine. And that's what we want as parents, right? We want to minimize risk. And so there is a balance game here. And schools right now do have strategies that they have implemented to make school as safe as possible.
Well, while schools are open, Doctor, a lot of offices still aren't. A lot of companies pushing back their return to office dates, some out even to January of 2022. But looking at what happened in the last fall and winter period, is there any reason to expect that January is going to be any better than where we are right now?
I really think it is going to get better. I'm quite an optimist when it comes to this virus right now. Vaccination rates have gone up. People have started adjusting the way they fundamentally live their lives, to wearing masks when they go to the grocery store, to minimizing gatherings. I think by January, we're going to be in a very different place. And also, let's be honest, cases are falling across many different states. So there is cause for hope, and we should maintain that we will get back to our new reality.
Well, for all of our sakes, I certainly hope that you're right about January, Doctor. But still, there is an ongoing conversation about boosters. Do you think the Biden administration is pushing the booster effort too quickly, or is the FDA and CDC acting too slowly?
It's tough. It depends what the purpose of the booster is. So if the purpose of the booster is to minimize the amount of transmitting virus, then that makes a lot of sense. And I think the Biden administration is pushing appropriately. However, if the purpose of vaccination is to decrease your chance of ending up in hospital with a critical illness, then the data clearly shows that whether you had the booster or not, you're still less likely to get as sick compared to those that are unvaccinated. So again, it depends what the endpoints are and what you're comparing. I personally would like a booster. I think boosters will make a lot of sense. It's just.
And I'm going to play stop on profit for Bitcoin at 46,141. 46,141. Okay, it will give us 0.5% in profit. Speak to you later.
Rise as the summer ends. I feel like we're going to see a downtrending of the virus very soon.
Doctor, that's what we want to see. It's good to catch up. Thank you. Dr. Bhakti Hansati there. Johns Hopkins Associate Professor of Emergency Medicine. Lisa, the full quote, Delta peaked in late August and makes a strong case for a pickup in jobs this month. The argument we have made that August marks the bottom in activity has also been strengthened.
And this, frankly, it was what you were talking about with the United Kingdom and the model there in terms of the peak and then starting to come down. Let's hope that they're right.
Let's hope they're all right. We need to get the Michael McKee take on President Kaplan,
yes,
don't we,
do.
Lisa?
100%.
We need to do that right now. Michael McKee, our international economics and policy correspondent. Mike, here's the headline from Dow Jones. Dallas Fed's Robert Kaplan was active buyer and seller of stocks last year. Your reaction?
Well, it's not new. Richard Fisher, who was the previous Dallas Fed president, also traded millions of dollars worth of securities in his tenure. It's not a good look, obviously, for people who don't like the Fed and think that the Fed is in thrall to the financial markets. Kaplan has a very long history in the markets because, of course, he started at Goldman Sachs. So I suppose that he's not a dumb guy. He probably got all the proper approvals, but again, it doesn't look great.
And especially the types of stocks that are more interest rate sensitive than possibly ever before. I mean, just to give you a sense, 27 total stocks. Holdings that are valued over $1 million include Apple, Amazon, and Alphabet and Facebook. These are the interest rate sensitive stocks. Does that make an issue for him?
It could, if somebody wanted to make something out of it, certainly. I mean, we have been talking on this station for several years now about the FANG stocks, so it's not unusual that someone would want to invest in them. And I suppose that you could make the argument that the Fed's zero-rate policy over the last year hasn't really done that much for any particular category of stocks. Zero rates have helped all stocks, so you couldn't buy equities really without getting the benefit of the Fed's action. But again, he's probably got the T's crossed and the I's dotted, but it isn't the kind of thing that's going to play well with a certain constituency.
Hey, Mike, thank you. Michael McKee, his take on the story from the Dow Jones, the Wall Street Journal, in the last 24 hours. Lisa, one thing we can't accuse President Kaplan of being is an uber dove on the Federal Reserve.
Yeah, I mean, that's the thing, is that he has been one of the most vocal about warning against financial excesses. So for that reason, perhaps people are saying this doesn't necessarily affect his stock picking nonetheless. And I think that this is important, what Michael McKee was saying. The Fed is a flashpoint for a lot of criticism. This doesn't really help from a PR standpoint.
This attracts it, just a little bit more of it anyway. Yields are coming in this morning. Good morning to you all. We're down 2 basis points on 10s to 135.29. In the equity market, basically unchanged on the S&P 500. Futures come in just a touch. Alongside Lisa Bravis and Katie Lyons, I'm Jonathan Ferro. Tom Keane back with us tomorrow. For our audience worldwide from a beautiful New York City, this is Bloomberg.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television. Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you see good value come into the markets like we saw earlier this year, step in and buy.
Markets love
this period of time, potentially, where earnings growth is good.
Unfortunately, I think we're going to have to wait a bit longer to see what the fundamentals really look like.
We don't start filling those jobs. I'm very nervous that some of those jobs will disappear.
Do we see anything in the last couple of weeks to suggest at this point that September is going to be a lot better? No.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz and the wonderful Katie Lyons. I'm Jonathan Ferro. Tom Keene back with us tomorrow. Your equity market, we're down 2 points on the S&P 500. We're down almost 1/10%. It's a no-drama Wednesday morning, Lisa.
It's a no-drama Wednesday morning. However, it feels like we're on the precipice of something, and that seems to be the warning from the likes of Credit Suisse and Morgan Stanley and even Citigroup as people look out at the bullish sentiment facing economic data that's waning.
Interesting, though, for the likes of Morgan Stanley, it's not a blanket downgrade to equity exposure, is it? It's a downgrade to the US and maintaining the story in Europe and Japan at a time when maybe the story abroad is equally not as constructive.
This ultimately comes down to a valuation question. How ahead of their skis have people gotten, given the fact that people are expecting earnings to do well and the fact that people are expecting the growth to pick up again in a couple of months? This is a pause, and a lot of people are talking more about buying the pause than they are about the consequences of said pause.
And ultimately, this has been a challenge, Katie, for a long, long time. You can get your economics call right, your macro call right, and you can get your market call very, very wrong.
Yeah, the economics and the market response to the economics, John, have seemed entirely disconnected for some time now. But I think also this differentiation between what we're seeing in Japan and what we're seeing here in the U.S. is interesting, because in Japan, you have seen a really strong run of equity gains after Prime Minister Suga said that he isn't going to be running again. There's optimism now that his successor will indeed bring more fiscal spending. And here in the U.S., part of what Morgan Stanley is flagging is the fiscal spending question and what we are going to see in terms of the long-term economic agenda in Congress. And with that as a question mark, it makes the U.S. case a little bit more difficult to make, at least for Andrew Sheets and company.
Policy risk stateside seems to be the two words that gets a lot of attention right now. Here's your equity market, your price action stateside. Equity futures coming in a single point on the S&P. It's not much to get excited about. We're down 0.02%. Into the bond market, yields in a couple of basis points, 135.12 on 10s. Crude positive, 69.27, up a little more than 1%. And Lisa, the FX market, as we inch towards that ECB call, euro dollar 118.20.
Will be really interesting in the next couple of weeks. Let's talk about fundamentals. 10 a.m. we get the JOLTS job openings for the month of July. How much do we see a new record high of north of 10 million job openings in the U.S. economy as these frictions do persist? I am looking also at the participation rate and how much this really bleeds into a participation rate that just won't go back to where it was pre-COVID. 1 p.m. we get the deluge of bond sales continued. 1 p.m. U.S. is selling $38 billion of 10-year notes. This follows the 3-year note auction yesterday, $120 billion of U.S. debt sales this week. 1:10 p.m., I'm very interested to hear what New York's Fed's John Williams has to say about the pace of the economic recovery, given the backdrop of Delta, given the roll-off of some of the fiscal concerns. He is one of the big three, in addition to, of course, Fed Chair Jay Powell and Rich Clarida. Will they start to taper sooner? Right now, the Fed's balance sheet, $8.3 trillion, John, a record, and probably going higher.
Elisa, stay on that. It's important. Even if they do start to taper, even if they completely unwind QE, that balance sheet stays exactly where it is, doesn't it?
I'm struggling to understand this argument that it's a removal of accommodation if basically a tapering means it continues to expand just at a slower pace. And I do wonder how much this is factoring into negative real yields that still are around -1%, even though we do have economic growth at the highest pace, even with the slowdown in years, John.
The stock effect's huge. That balance sheet's massive at the Fed, at the ECB too. Katie Lyons, even if they end QE, that balance sheet will be reinvested for a long, long time.
Yeah, and John, it's a question of whether or not the taper actually makes a material difference to this equity market. I've heard you ask the question so many times, what do you get for $120 billion a month that you don't get for $60 billion a month, even $40 billion a month? And the timing question as well, what difference does a September announcement make, or maybe the lack thereof, make relative to a November or December one, John?
Even 20, even 10, or as Michael McKee has asked, even zero, perhaps, as well. Everybody seems to be saying this morning and over the last few weeks, expect volatility. This is the line from Citi. Expect volatility because we are no longer at the beginning of this cycle. Leadership becomes less clear at this time in the cycle, and while the leadership will narrow, it can also be quite choppy. Let's get to Kristen Bitterly, Citi Regional Head of Investments for North America. Kristen, let's start there. Why should we expect volatility?
So when we look at any cycle, right, when you're looking at the beginning of a cycle, that's where you see the strongest rallies. And we've seen that over the past 12 months. We've seen essentially everything moving up, and there's been periods of different leadership, very clear periods of whether it was growth versus value, COVID defensives versus COVID cyclicals. But now the leadership isn't quite clear. And so one of the things that has investors very, very nervous, and why we're expecting volatility, is that realized volatility in U.S. equity markets are at the lowest end of the 20-year range in the single digits. And you can see this through the market action that we've seen. We've not had one pullback of 5% or more in 2021. This has only happened twice since 1980. And while we've had a couple of pullbacks of about 3%, they've been bought very, very quickly. And so I think this has a lot of investors wondering, okay, will we actually see realized volatility rise? And will that put us into what is actually a pretty normal equity market of a couple pullbacks of 5% or more, and even up to one of 10%.
But Kristen, is this the same equity market as 10, 20, 30 years ago? And I'm looking at the dominance of the big names. I'm looking at the composition that has actually performed very differently depending on which sector of the market you're looking at. I mean, can we get a broad-based 5% drawdown given how much money and given how selective people are with respect to sector selection?
Yeah, it's a great point, right? When we're looking at the rally that we've seen, even year to date, there has been a lot of breakdown in correlation. So up until even recently, right, the underperformance of small caps, when you look at what we went through with the Delta variant, almost like a mini kind of what we went through last year in terms of tech coming out ahead as opposed to value really dominating the first half of the year. I think what the market is going to differentiate going forward, and this is where we're allocating in our portfolios, is to quality. So this becomes much more a conversation around those companies with strong balance sheets that have the ability to grow their earnings, have the ability to grow their dividends, which is very important in this rates environment. And so earnings are really going to drive this conversation and fundamentals going forward.
So a flight to quality, you have a lot of other calls to get a little bit more defensive within this equity market, Kristen, but is it time to go to cash?
So we do not believe it's time to go to cash. So cash, there's really multiple purposes of cash, right, from an investor perspective. One, of course, have a safety net, have your operating cash, what you need. But in terms of an investment right now, when we look at the inflationary pressures, this is an asset that's guaranteed to lose money. And so if you want some tactical cash in your portfolio because you are there to buy the dip, you can confidently buy the dip. There's some value in that. But what we're seeing in a lot of investors' portfolios, and we've seen this for several months, is a lot of cash sitting on the sidelines. So this is no longer about an investment decision. This is really someone trying to market time, which doesn't work in the short run or the long run for that matter.
Kristen, just to conclude, I want to go through this research report and make it really clear some of the things that you're highlighting. Lumber down 72% since May. Iron ore down 30% in the same time period. Chinese equities down 30% since the middle of February. Brazilian equities getting hammered as well. US small caps underperforming 20% since the middle of March. At the time of publishing, those numbers, I assume, were correct, and I'm sure they're still there and thereabouts the same. Kristen, what's the punchline here?
So the punchline is, despite a lot of the central bank support and liquidity, markets are differentiating, right? And that's quite healthy. I think what you need to do as an investor, again, always bringing this back to actionable ideas and what we can do within our portfolios, is this becomes a period of being selective, right? This is not a market of everything is going to go up, everything is going to win. And so being selective, not only in terms of regions of the world that you're in, as you've been discussing all morning, but also in terms of security selection, because there will be winners and losers based on fundamentals and earnings.
Kristen, always good to catch up with you. Thanks for being with us. Kristen Bitterly there of Citi. Lisa, that punchline there, despite a lot of central bank support and liquidity, markets are indeed differentiating, and we've seen that beneath the surface through the whole of this year.
They're differentiating at a very high valuation, right? And this is the key point, right? And now the key is to continue to differentiate at that very high valuation level, not necessarily bring down valuations across the board. So at certain point, yes, central banks perhaps have propped everything up as much as they are going to, and now companies have to differentiate themselves, but they're not going to take the punch bowl away with the high valuations all around.
Sure, the big reopening trade, though, has certainly faded.
Yeah.
The airlines peaked, Kaylee, back in spring, and the airlines continue to have a difficult time.
Yeah, it's a question of whether or not they kind of front ran the news, John. In the first 3 months of the year, we saw those kind of reopening plays ripping higher, and then they have really come off of those highs, as you say. And it's a market that continually seems to get ahead of itself. And for some of those reopening plays, it seems that came earlier rather than later. But also, as Kristen Bitterly was alluding to, small caps, another trade that was, you know, the consensus call coming into this year and just has not worked in the way that many people expected. But again, that was an area of the market that had seen an incredible run up that has since faded.
And it had a tough time yesterday as well. Lisa, do you think that's the trade for the braid right now?
Airlines?
The trade for the brave, not just the airlines, but the cyclicals more broadly, leading into that story a little bit more. Kaylee kind of touched on this, and I think it's important. What we're witnessing right now, the data we're looking at, does it reinforce a move we've already seen, or is it some fuel for another leg of it?
Here's what I'm struggling with. A question that you asked earlier yesterday when you were talking about, is this a recovery delayed or is this a recovery derailed? How long does the slowdown have to occur before there is some sort of permanent, not necessarily scarring, but permanent effects on the economy? And airlines are number one, especially given all their debt and given the fact that they really have to recover a whole host of costs.
It got a real sense for the bias on Friday, didn't we?
Yeah.
Downside surprise on payrolls, and overwhelmingly the reaction was what? Look through it?
Yep. Not
equity futures this morning, down about a point on the S&P. We're looking through it. Feels like summer. I was told summer's over. This looks like summer.
You're wearing a white shirt. So,
Yields are in a couple of... Can I not wear a white shirt in summer?
I'm just being...
You're making up the rules.
I'm making up the rules.
Down 2 basis points, 134.95 on 10s. The fashion expert himself, Tom Keene, back tomorrow.
With a tan suit.
With a tan suit, no doubt. Looking forward to that. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. In the UK today, Parliament is expected to vote on Prime Minister Boris Johnson's call for $17 billion in new taxes on workers and companies. They will go towards paying for improved social care. Johnson's Conservative Party is traditionally against higher taxes, but the new revenue will help trim budget deficits bloated by the pandemic. In Japan, the government reportedly has told the ruling coalition it will extend the coronavirus state of emergency for 19 regions until September the 30th. That's according to NHK. The emergency covers Tokyo, Osaka, and 17 others. 2 other regions will be downgraded to less strict virus measures. President Biden warns that New York and New Jersey are signs of worsening climate change. The president toured the region days after remnants of Hurricane Ida pummeled it with high winds and torrential rains. He said Congress passing his $550 billion public works bill would help build more resilient communities. Aluminum is inching towards its highest price in 13 years. That coup in Guinea is one reason. The country is a major supplier of bauxite, which is used to make aluminum. That's added to an uncertain supply outlook just as global demand booms. And what was assumed to be Apple's next big thing is suddenly in doubt. The company's top auto exec, Doug Field, has left to become Ford's chief advanced technology officer. Apple's been developing a self-driving car. Field is the 4th executive leading the effort to step away in the unit's 7-year history. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP? It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at the frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Somebody said, I want to be the next Reid Hoffman. What would you say is the best training ground to do that?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every part of the country is getting hit by extreme weather. And we're now living in real time what the country's going to look like. And if we don't do something, we can't turn it back very much, but we can prevent it from getting worse.
The President of the United States on climate change speaking in New Jersey. Lisa, he'll speak again a little bit later this morning, 11:20 you said.
Yeah, 11:20 is going to be talking about labor unions, which is kind of an interesting moment. Interesting also that it's following that JOLTS data that we're getting in about a little less than 3 hours.
I understand Secretary Walsh will be with him as well. Lisa Bravitz, Jonathan Ferro, Katie Lyons this morning, Tom Keane back tomorrow. Here's your price action in the equity market. The S&P barely positive, up a single point, not doing much at all today. Unchanged on the S&P, unchanged on the NASDAQ. Into the bond market, yields lower by a couple of basis points. It's a little break at 135 to 134.95. Andrew Sheets of Morgan Stanley talking up policy risk. We can talk about monetary policy all day. Let's talk about fiscal policy now down in D.C. with Jack Fitzpatrick, Bloomberg government reporter. Jack, let's just start right here. The battle over the pay-fors for taxes. What does it look like right now down in Washington?
It's looking pretty tough. Obviously, you heard Senator Manchin's comments recently about sort of being skeptical about the $3.5 trillion top line. Yesterday, we also kind of got a sign of how difficult it can be to add up these numbers for Democrats. The House Tax Writing Committee, the Ways and Means Committee, put out basically the spending half of their part of this bill. That's an expansion of Medicare, 12 weeks universal paid leave. They actually are bumping back the beginning of some of those benefits because Congress measures the cost in 10-year windows. And so to sort of artificially minimize the cost that they would have to balance out with tax increases, they wouldn't even start dental benefits for the expansion of Medicare until 2028. That's kind of a sign that they're really trying to squeeze as much out of this bill as possible, even in maybe slightly gimmicky ways when it comes to how they measure this. They also haven't put out their tax increase proposals yet. So we're looking to see if they start off with that 28% corporate tax rate that Biden has proposed, How quickly do they have to scale it back to something like 25% that Manchin has countered with? But clearly what we're seeing so far is that it's very challenging for Democrats to make the numbers add up and actually end up paying for all the expenditures that they want.
Meanwhile, as the president tries to push these bills and his agenda through, he is speaking, as John was just saying, at 11:20 a.m. on labor unions alongside Marty Walsh, a longtime labor member. And there is a question of how they're going to try to push worker power at a time of a record high number of job openings, at this dissonance, this friction in the labor market. What are they doing on that front?
Yeah, I think the comments obviously are timely because of Labor Day recently. But, for one, the administration, when you talk about the number of job openings, the administration did not push particularly hard on the issue of extra pay. The administration was actually the first among Democrats to say, we're really just going to allow the extra unemployment insurance money to expire in September. We don't know if there's going to be much of an announcement today on labor unions and that kind of thing. But obviously, in the broader context of what the Biden administration wants to accomplish, a pretty significant focus on increasing wages, potentially even at the expense of lowering the unemployment count. Not exactly sure how significant the announcement will be today, but obviously the issue of unfilled jobs is going to be a significant one going forward.
Jack, perhaps it's not significant. Perhaps there's not an announcement. However, he's trying to cater to a more progressive branch of the Democratic Party at a time when he is losing clout pretty steeply with them. In addition to just broadly, his approval rating has steadily declined, especially after the Afghanistan exit. How much does that affect his ability to get the agenda through at this point?
It definitely hurts just to see his approval rating drop at the time when he's trying to push this through, because it could embolden some of the moderates who are pushing back against certain aspects of how Democrats are pushing for Biden's agenda. You saw that earlier with a group of House moderates fighting against the idea of tying the infrastructure bill and this reconciliation bill together. Obviously, you see a lot of comments from Senator Manchin, some from Senator Kyrsten Sinema. If you don't feel absolutely tied to President Biden's political success, you have more reason to drag your heels on the legislative agenda and push for the things you want, or maybe even just to slow down or minimize the scope of everything Biden wants. It hasn't killed Democrats' plans yet, but this is not a great time for his approval ratings to be taking a dip.
Is the impetus behind the legislative agenda maybe pushed forward a little bit by Hurricane Ida and the destruction we've seen? Of course, the president here in the New York and New Jersey area yesterday, I saw Marine One fly right past my apartment building. He was talking about climate change and really pushing the need for some of this funding. Is that now easier to get done?
Rhetorically, that can play into both of these major bills. The need for an infrastructure bill maybe becomes a little more obvious given some infrastructure failings with Hurricane Ida. The climate measures are a significant focus for Democrats in this next big bill. It also just makes things difficult, though, because it adds to their plate of what they have to accomplish in the very near future. One, Democrats want to pass the infrastructure bill, this $3.5 trillion bill, or whatever it's going to end up being. Two, though, they have to fund the government past September 30th, and now Biden has requested not only funds for Hurricane Ida recovery, but funds for other natural disaster recoveries, other hurricanes over the last year and a half, wildfires, and additional funds for Afghanistan to get people out of Afghanistan to be attached to that government funding measure. So there's just more on their plate now than these two major things in the news, and it makes it a bit of a crowded congressional schedule.
There's a lot on that one man's plate, that's for sure. Jack, thank you. Jack Fitzpatrick there, Bloomberg government reporter down in Washington, D.C. Lisa, what would surprise you more, if they got something done or didn't get anything done?
If they didn't get the $550 billion bipartisan stimulus, I would be surprised. And frankly, I think that markets would too. If they get something north of $2 trillion done on the social spending side, that seems like it would be somewhat surprising. Of course, how they pay for it really matters here in terms of what the market effect would be.
Yeah, the reason I ask is from a market standpoint, Kayleigh. Would we have a surprise if they got something done? Would it be a bigger surprise if nothing happened? Would it be a bigger surprise if we actually just glide through year end, get a load of things done, have an agreement over the debt ceiling and move on?
Oh, perfect world picture you're painting there, John. I think that indeed would be a surprise if everything were to go that smoothly in Washington over the next 60 days or so. Morgan Stanley certainly doesn't really believe that it will, but I think the question around whether or not they can get the bipartisan infrastructure $550 billion plan done is not separated from the trillions in other social spending. The House has indicated that they won't let those two things happen without each other. And so I don't know if I agree with Lisa that I wouldn't be surprised to see the bipartisan bill not getting done if the Democrats in the House can't get what they want.
Lisa, is that the first time I've been accused of painting the picture of a perfect world?
Yeah, that's absolutely. And I don't know.
First time for everything.
Perfect. Honestly, I think that people are expecting something to get done. Whether it's a wash, given the tax increase, is unclear.
Lisa Brammertz, Kelly Lyons, Jonathan Ferro, Tom Keene, back with us tomorrow. Your equity market, it's a snooze. Your equity market goes nowhere on the S&P. Yields in a couple of basis points on 10s to 135.12. This is Bloomberg.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Breaking news, summer isn't over. That's your headline. Go back to bed. The equity market on the S&P 500 unchanged. Am I not meant to say that, Lisa? Futures on the NASDAQ unchanged. Futures on the Russell unchanged. All-time highs on the NASDAQ, so let's talk about that. Our inability to defang the virus has refanged big tech. Switch on the board and get to two names. Romain will go through the winning streaks of some of these names. Netflix is on an absolute tear. Apple on a 4-day winning streak. Netflix is up almost 20% since the middle of August. This morning, again, we add a little bit more weight to the rally in the pre-market, advancing 0.2% on Apple. Netflix up another 0.1%. Is that the story back in vogue? It's hard to reconcile with what's happened in the bond market more recently because yields haven't been coming lower, they've been going higher. So let's finish on that. Switch up the board, 2s, 10s and 30s. Yields lower Friday, lower again, higher Friday rather, higher again on Tuesday and lower this morning by a couple of basis points to 135.12. On 30s, we come in 2 or 3 basis points to 195.84 on 30. So this curve, a little bit flatter this morning, yields a little bit lower. Lisa, it's been difficult to get a read on this bond market for a very obvious reason. Difficult because we've had so much supply. On the corporate side, a lot got announced yesterday, and on the sovereign side, we'll see 10s today and 30s tomorrow.
There's been so much supply, and there's been the cash to meet it, and that has been the shocking aspect, especially as you have the likes of the ECB and the Fed talking about tapering. It hasn't diminished that demand.
Go back to bed. You can listen to it on radio. This is the beauty of this program, isn't it, Lisa? That if you
can I go back to bed?
You can go back to
Thanks,
bed.
I'll be sleeping over here at the podium.
We can call in and talk to you, and it will work on radio. Maybe not so much on TV, but that's up to someone else. 135.12 on 10s this morning. Let's get you those movers. Here's Romain.
Hey, good morning, John. Yeah, you talk about the win streak some of those stocks are on. One of the relative laggards was actually Tesla, though. It's managed to put together a 3-day win streak here. It's slightly higher here in the pre-market. You got in latest data here out of China. Remember, it had a really awful month with regards to the domestic shipments from its Chinese factory in July. That had dropped 69%. The latest numbers show a rebound in August, up about 50% with regards to domestic shipments. When you fold in the amount of exports from that Chinese factory over into Europe, it's about a 44% gain here. Some investors starting to re-embrace this name, now at around 759, still well below its all-time high, but starting to get a little bit of momentum. Keep an eye on analog devices here. Those shares higher here in the pre-market as well, up about 2%. It was interesting. They came out with earnings last month, and they guided higher here on revenue. They're now revising that guidance even higher, above $2 billion, up from a range of what was basically about $1.7 to $1.8 billion. Now saying that's going to be well above $2 billion, also revising their EPS estimate, though they're providing a wider range, also announcing a $2.5 billion accelerated stock buyback. And then you have Coty moving in the opposite direction, the beauty products retailer down about 8% here pre-market. The company basically coming out and saying that it had a secondary offering. It's going to close tomorrow for about $8.53. That's about 8% below where the stock closed yesterday here, catching investors by surprise here. A little bit of dilution. Flip up the board here. And let's see what else is going on here. It'll be interesting to keep an eye here on Coinbase. Remember, the shares fell yesterday about 4% because of the drawdown with regards to Bitcoin. But late last night, right before midnight, they disclosed that the SEC here in the U.S. had actually issued a Wells notice and threatened to sue them over a lend product. This is basically a product where you can earn interest on your crypto holdings here. It's a controversial practice that the SEC has flagged before, but they did send a Wells notice to Coinbase. Coinbase did not say specifically if it would stop offering this product or stop plans to offer the product, but the chief legal officer basically said the SEC gave it an opportunity to respond, but said it would be, quote, futile because it did not understand the SEC's motivation. Keep in mind, Gary Gensler, the SEC chairman, he's scheduled to be on Capitol Hill next week. PayPal Holdings moving higher here on a bid to buy Payday. This is a big Japanese buy now, pay later business backed by George Soros Capital Management here. It's a $2.5 billion deal, $2.7 billion deal. Remember, Jack Dorsey's other company, Square, had that $29 billion deal to buy the buy now, pay later business over there in Australia, Afterpay. So both of these companies really moving into that buy now, pay later model. And you mentioned Netflix a little bit earlier. Now on an 8-day, 11% 1% winning streak. If it manages to hold the gains here in the pre-market, which are only up about 0.2%, that would be a 9-day win streak, its longest win streak on record, basically since it went public back in 2002. There have been no real catalysts here, though some analysts have turned bullish on this. JP Morgan actually raising its price target. Barclays talking about the company's slate of not only content, movie content, but also its foray into gaming and saying that could be a game changer as we get deeper into the year.
Hey, Romain, let's build on that. Do you sense that is a macro story then, or a single name story? What's going on there? That's an 11% move in 8 days.
It appears to be a more of a macro story. We've been talking a lot about this on the close. It's not just Netflix, but a lot of these names that were sort of embraced earlier this year and kind of fell out of favor because of valuation concerns have now been re-embraced. I guess you can sort of maybe read into the possibility that these are defensive trades and less about the growth itself. It's hard to really know, but you definitely see a re-embrace of the Netflixes, the Apples, even the Teslas. The idea here that this offers maybe a little bit of safety when you have this uncertainty with regards to the yield picture.
Hey, Romain, thank you. Yeah. Looking forward to the close a little bit later this afternoon on Bloomberg Television. Lisa, what do you make of that? NASDAQ, all-time highs. Romain going through some of the names there. Netflix, Apple, very much back in vogue.
Yeah, the idea of the ones that cooled off, too, for a while. I mean, Netflix had a pretty rough patch for a while as people looked past COVID and said, well, you know, people aren't just going to be able to sit home in their pajamas watching movies anymore. They actually have to go out and do something. Now, perhaps we're all back in our pajamas, as
Are you
pointed
suggesting
out.
people have been in their pajamas doing nothing?
Not nothing. They've been logging on,
okay.
but at their kitchen tables.
All right.
Come on, wearing white for the summer.
I don't know. I never got to do that.
Look at those markets.
Look at them. Lower by a couple of basis points to 134.95. Parag Garvey joins us now of ING, the head of global debt and rate strategy. Parag, hard to reconcile the move we've seen in big tech with the move we've seen in the bond market over the last couple of days. Yields higher. What do you make of that? Anything to see?
Oh, absolutely. I think it all came from Friday's payrolls report. In fact, what we saw there was a weak number, and it means stimulus. It's as simple as that. It's very difficult for the Fed to move away from the taper. It's very difficult to really contemplate a rate hike scenario. So we've got a mountain of cash washing around the front end, adding liquidity, and it's risk on, and it's rates up. And that makes a degree of sense right now. I mean, what I see in the front end is liquidity absolutely dampening down rates there. The back end is more untethered, and I think there's an influence from Europe as well. The 10-year bond yield is also up. It's been a theme that's developed over the past 3 weeks, but payrolls, funnily enough, gave us an extra kick higher in rates.
So, Parag, there has been a record number of investment-grade bond sales over the past few days. Yesterday, 21 issuers came to market, which is an all-time high for that day. Are you buying into this, or do you think that this is perhaps too good for the borrowers and not really all that good for the buyers?
Well, it's fantastic for borrowers. Risk-free rates have rarely been lower. Bank spreads on the floor, credit spreads exceptionally low. Great times for them. But look, the thing is, supply has not been an issue for this market for quite some time. There is a lot of cash put to work out there. And we're seeing this in the sense that corporates are quite happy to build up cash positions in money market funds. Investors are quite happy to buy the yield. We've seen outflows from prime funds because there is no yield there. So anything that offers some yield over the miserable risk-free rate we have right now is being snapped up by investors. We saw it yesterday again in the 3-year. Huge indirect bids, very strong demand.
So, Parag, obviously you've had a lot of supply, but we're going to see less supply coming from the Treasury over, the coming months. We might start to see a reduction in that. How does that pair with a potential Fed taper?
So the interesting nuance there is the debt ceiling, in the sense that it's difficult for the Treasury to issue bonds as they have effectively hit the debt ceiling. So yes, there is a pressure to reduce that supply. In terms of the level of rates, I can't imagine it's going to have a big impact. If it's going to have any impact, it's going to push rates higher. I think at the moment we're in a very low risk environment. And the feeling is you can buy practically anything apart from the ultra dangerous high yield or the high beta EM and feel pretty comfortable about it. So, I think it's going to work both ways, but other things being equal, less supply should put upward pressure on rates. Difficult to imagine much upward pressure, but some upward pressure.
Parag, great to catch up with you, sir. As always, Parag Garvey there IG head of global debt and rate strategy. Just on that move we've seen start to build the last couple of days, Friday, Tuesday into Wednesday, Lisa, high yields. This morning, just a little bit lower, not just in the United States where we're down a couple of basis points on 10s to 135, but also in Europe, in Germany, in about a basis point there to negative 33 basis points on a 10-year bond.
Just higher yields, but again, we're coming from such low places as you're talking about negative 33 basis points on the 10-year bond. I mean, a rise of this is not discouraging people from borrowing, and there is so much money to soak up that supply. I am just wondering at what point there will be perhaps a hangover effect as corporate America just continues to borrow record amounts of debt. I understand some of them are deleveraging, but still, John, I mean, record.
It's pretty impressive. I mean, look at the numbers for the Treasury. 38 billion of 10-year notes today, 24 billion in 30-year notes tomorrow. Direction of travel matters, and most people assume that this is going to start to go the other way, Lisa. But these numbers have just been huge over the last year.
And it just highlights the amount of cash sloshing around, as Porek was talking about, this idea that there is all of that to potentially soak up. I have a question for you, John.
Sure.
The ECB, if they come out and they say that they're going to start tapering or even talking about tapering, how big are the ripple effects?
Oh, I think it could be big. Look, I think to some degree over the last 10 years, rates have been anchored by what has happened in Europe. And to some degree, if you've got a big bet on high yields, and I think I'm stating the obvious here, that's got to be born out of what happens in Europe. And if Europe's going to stay anchored down here for a long, long time, look, Lisa, for me, it's less about whether Europe becomes more like the United States and starts to get high yields and have a real cycle where interest rates go higher, and unfortunately much more about whether the United States starts to become more like Europe, more like Japan. For a whole range of issues, more specifically, the Fed gets trapped down here, near zero rates for a long, long time, and they get cornered in. I think it's something Mohamed Al-Erin mentioned recently, and I think it's really important. There's a window here for the Fed to do something. Lisa, there are some people that think they might miss it.
And if they do miss it, they won't have enough time to taper before they have to necessarily counteract the downturn in the next cycle.
And the ECB is going to be an economy that needs to be supported for a while. Let's be clear about that. I don't think I'm being controversial here at all, am I?
You're not being controversial, but I would say I'm watching the ECB very carefully. If those yields rise, the U.S. yields can rise a whole lot more.
Looking forward to that news conference tomorrow on TV, on radio. I'm crossing my fingers because I've been promoting this one through the week already, and I've been disappointed so many times. In the equity market, we're unchanged on the S&P, and the bond market yields in to 135.12. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The White House says 3/4 of U.S. adults have now received at least one dose of the coronavirus vaccine. Still, there's been a recent surge of cases due to the Delta variant. Tomorrow, President Biden plans to outline a new strategy to get the pandemic under control. The U.S. is well behind many other countries in inoculating its population. That's due to the hesitancy of many Americans to get the shots. China's moved to complete its purge of Hong Kong's election system. New rules make it all but impossible for opposition lawmakers to return to the city's legislature. In the last 10 months, over 300 elected legislators and district councillors from pro-democracy groups have resigned or been removed from office. Tesla's shipments of China-made cars to the local market rebounded last month. Elon Musk's electric car maker reported domestic China shipments rose almost 50% from July, when they had plunged 69%. Exports from Tesla's Shanghai factory, most of them headed for Europe, also rose. And Bitcoin fell as much as 17% yesterday after El Salvador's troubled rollout of the largest cryptocurrency as legal tender. The country's experiment had a rocky start because of technical glitches that later appeared to be resolved. And sell-off is the most significant break in a rebound that had lofted Bitcoin almost 75% since late July. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early start to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
In the last 8 weeks, there has been a giant realization that crypto is not just Bitcoin being bought as a hedge against bad monetary and fiscal policy, but maybe more importantly, it's Web 3.0. There's a realization that this is a technology play, and no investor wants to miss the next internet. This is the next internet.
That's the opinion of Michael Novogratz there, the Galaxy Digital founder and CEO. From New York City this morning, good morning. Alongside Lisa Bramett and Kaylee Lyons, I'm Jonathan Ferro. Tom Keene back with us tomorrow. Here's your price action. On the equity market, we're a little bit softer, with the emphasis on a little bit. We're down a point on the S&P. We're negative 0.03%. Into the bond market, yields in a couple of basis points to 135.12. Crude 69.32, call it 69.30, up by around about 1.4%. And euro dollar slightly negative. It's a weaker euro going into the ECB. Euro dollar 118.22. We're down a little bit more than 1/10%. It's that time of the morning when we catch up with our stocks editor, Dave Wilson of Bloomberg. Dave, what have you got?
Well, John, taking a look at a report I actually mentioned yesterday from Keith Lerner over at Truist Wealth. I was talking about it previously in the context of, how long has it been since we've seen a 5% decline in the S&P 500 or more, or how many years do you go without one? And it turned out it was only 2 in 1995 and 2017. But this one is focusing on the relationship between the S&P 500's performance this year and what's happening to forward earnings. In other words, analyst projections going out 12 months. And the way that Lerner looks at it, you could basically explain the entire gain in the S&P 500 this year by looking at what's happening to these profit forecasts. You're up roughly 20% on the S&P 500 for the year, but if you look at the forward earnings based on our data, they're up 29%. So, what we're seeing is at least you've got the kind of profit growth to support what's happened this year in the S&P 500. Now, analysts are certainly looking for that to slow down in the third and fourth quarters, and presumably even more out to next year when you get those comparisons with, shall we say, the pandemic recovery that we've been seeing this year in profits. Nonetheless, you still have a market that's kind of moving, in a sense, in a fundamental way, and that's really Lerner's point here.
Dave, thank you. As always, our stocks editor, Dave Wilson. On Bloomberg TV and radio through the day, Katie Lyons is doing accounting. Katie, how many days?
211, John.
211. 211.
Today
Liz.
will be 212.
Yeah.
We just keep climbing.
Yeah, and then you add to that the, how many is it? 43 record highs so
54.
far. 54.
54. You're a machine, Katie Lyons.
96.
A machine. You see Ray Dalio this morning on China. Here's the quote. It's a part of the world that one can't neglect, and not only because of the opportunities it provides, but you lose the excitement if you're not there. I mean, look, that's the eye of the beholder right now, Lisa, isn't it? I don't know if you want the excitement of what's happening currently.
Well, and this is the question, can you be invested right now? Wow, I'm two right now. Can you be invested in an area where you have such uncertain regulatory power? Although there is this debate increasing among officials in China over just how much they should crack down versus reassure businesses they're not going to undermine their models.
Let's get out to Hong Kong and catch up with Enda Curran, Bloomberg's Chief Asia Economics Correspondent. And the common prosperity, can we talk about that and the debate in China that's playing out at the moment on exactly what President Xi is doing and what it means?
Well, Jonathan, if global investors are confused, it looks like there's some confusion in China as well about this massive new policy agenda. We're getting some sense of that confusion in the state press in China. On the one hand, we've had an influential blogger and some state media pushing this idea of a profound revolution in terms of the change that's coming. But on the other hand, we had a pushback from a very influential tabloid called the Global Times, making the point that, look, this is going to be a gradual social change here. This is a fairly unified approach from the top of government in China, and it's all about making a more equal society and a more sustainable economy. And at the same time, we've had some top officials coming out, or at least a top signal on the front page of the People's Daily today, telling the world that China remains open to foreign capital, and that will, of course, there's always going to be a place for private business. But I think a lot of foreign investors, when they hear that message, will say that they've heard that once before.
Well, who do they listen to? Xi Jinping is the leader. He doesn't normally necessarily take feedback with some sort of collection box. Who do you listen to here?
I think there's a face value aspect to all of this. You've got to be clear that what the Chinese government are saying they're going to implement, it's a fairly aggressive approach in terms of what they want to do on the equality agenda. We've seen this crackdown already on online education. We've seen this aggressive crackdown on technology, but of course it's now reaching into many other sectors. There's more to come with a potential crackdown on the property sector, for example. But at the same time, the question becomes, you can pursue that agenda, but can you really pursue that agenda and achieve the kind of growth and innovation story that you want, the kind of growth and innovation that you need for China to achieve its economic potential? And I think that's where the global debate is saying, hang on a sec, just what is going on in China here, waiting for clarity, waiting for a sense as to how all of this is going to play out. China's pushing a bigger picture that is good for the economy, but investors aren't so sure near term.
Well, part of China's push has been targeted at the property sector, and I do want to ask you about something we've called attention to a few times already this program. What's happening with China Evergrande, downgraded at Fitch and also at Moody's. Fitch talking about a probable default. What would the implication be if we did get a default?
Well, it's the world's most indebted developer. It is a huge part of China's financial liabilities. It's got over $300 billion worth of liabilities in total. And like you say, that credit rating downgrade today sent the bonds into another spiral. And again, this goes to the whole debate about what is too big to fail in China. We had this debate recently about Huarong, one of the four bad banks, and the story was there's going to be stress on its bond repayments, but ultimately there was a kind of a shoring up there from the central government. So the question now is what's going to happen with Evergrande, which is of a different order of magnitude bigger when it comes to the liability story. It's not yet clear what will happen, but to your point, if there was a default, it would be a shock. It would certainly send some tremors through the financial system, and you would have to assume that you know, China's all about stability at the moment. You'd wonder whether they really do want that message going to the world that their financial system is shaky. So that's why there are two camps in this. One camp saying there's a restructuring coming, another camp saying that the state will always be there to step in.
Enda, good evening to you, sir. It's good to catch up. We appreciate it. Enda Curran there of Bloomberg on the situation in China, including Evergrande, which the stock, and we talked about this earlier this morning, had a brief flirtation below its IPO price from way back in 2009. Lisa, which was 350. The stock closed positive, but the attention, quite rightly, in financial markets, for institutional investors especially, is what's happening with the bonds and what is happening more broadly for high yield in China.
And the idea of potential levered purchases of the stock, of the bonds that could potentially be underwater. Could you get forced sales? The idea that this company has $305 billion of liabilities to the likes of homeowners, developers, as well as, of course, the shadow banking system in China. Again, what we saw with Archegos is we don't understand all of the nodes of connection here, but they exist increasingly more than ever before.
Can you achieve so-called common prosperity without putting the squeeze on the property market and getting some fallout for the likes of Evergrande?
Right now, it seems like it's unclear because
That's
it
where
has
the tension is, right?
Yeah, that's where the tension is. I mean, we haven't gotten a conclusive answer to that.
Lisa Bramers, Kelly Lies, Jonathan Ferro on Bloomberg Surveillance, heard on Bloomberg Radio, seen on Bloomberg TV, with your equity market doing a whole lot of nothing on the S&P 500 and yields coming in a couple of basis points to 135.12. This is Bloomberg.
会場に行って観戦するということも難しいお子さんがいるんです。このように冷房の効いた香港の体育館の中で、それこそ大会の最前列で観戦ができる、体験ができる、こういうことをとてもありがたいことだなというふうに思っていますし、この技術に感動しています。予想以上に子どもたちの反応が良かったというのはですね、とても校長として嬉しく感じております。この子どもたち、どれだけオリンピックの心待ちにしていたのかといったことがよくわかるような今日の表情です。
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Power of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
September is usually a tough month for equities, and as a result, we think that's going to play out this year as well.
Earnings are really going to drive this conversation and fundamentals going forward.
Do we see anything in the last couple of weeks to suggest at this point that September is going to be a lot better? No.
Unfortunately, I think we're going to have to wait a bit longer to see what the fundamentals really look like.
The Federal Reserve, during this cycle and perhaps typically moves in a very slow, sure and steady fashion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Who said summer was over? From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Lisa Abramowitz and Katie Lyons. I'm Jonathan Farrow. Our good friend and colleague Tom Keene, he'd call this one, Lisa, a snooze fest.
And he'd be completely right, at least when it comes to the action with respect to prices. However, there is real market activity when it comes to selling debt. And we're seeing it at a record pace in the corporate debt world. We're seeing it at a torrid pace across the world, sovereign debt-wise. Interesting that that is not actually having an effect on yields. If we're going to say anything interesting about this snooze fest.
Yields higher at least over the last couple of days coming into today. I'm trying to sell something that's not there to sell.
Great job.
Yields are 135 on 10s right now. Lisa, the people who were cautious are still cautious, and they've got a ton of reasons to be cautious, and that seems to be the story in the past 24 hours.
What's interesting is how they're cautious. It's not go to cash. It's not, hedge your bets. It's just rotate into something that's perhaps a little bit safer and wait for a buying opportunity, which tells you everything you need to know about just how bullish this market really is, John.
Yeah, I've heard that from so many people, Lisa. You don't cut your overall equity exposure, you just sort of shift the composition of it.
And then you're fine, then you're protected, and that's what we've seen in the market so far this year.
Or the B word, how many times have we heard that? The barbell, the barbell. The one side this, the one side that.
New drinking game.
Seriously, sitting on the fence worldwide. Let's talk about Morgan Stanley. Look, Kaylee, Andrew Sheets has got a ton of attention on cutting US equities to underweight. Less so is Ellen Zentner over at Morgan Stanley, who is making the point that we've seen the worst of this. The doubts have peaked back in August, and we've seen the worst of it for the economy, the worst of it for the virus.
And she seems to think that the month of September will actually turn out okay, at least from a labor market point of view. But Andrew Sheets and the team making the point that even if we've seen the worst, that doesn't mean we won't have a lot of volatility and a lot of risk factors at play in the next 60 days through the end of October. And they aren't just talking about those economic risk factors that Ellen Zentner is pointing to, John. They're also talking about policy risk, both in terms of monetary policy and also fiscal policy and what the legislative agenda is going to look like down in Washington,
Well, let's
D.C.
talk about policy risk. What is the policy risk right now, Kaylee? What are they actually talking about that we aren't talking about more broadly anyway and anticipating now for the last several months?
Yeah, there's a question of whether or not it's really a new risk, John, because we all know the taper is coming. It's just a question of timing, but maybe that uncertainty, it breeds more uncertainty, which, as we know, the markets don't really like. So that may be more of what Morgan Stanley is pointing to here. But I think a relatively underappreciated risk and uncertainty for the past several months have been on the fiscal front. But now that may be coming back to the forefront of the market's attention.
The equity market right now just off all-time highs. A bit softer in yesterday's session. This morning, not doing much. S&P 500 futures totally unchanged. Into the bond market, where yields are lower by a couple of basis points on 10s to 134.78, a small break of 135. Into the FX market, euro dollar 118.25, just a little bit weaker here, negative by a little more than 0.1%. Going into the ECB tomorrow, we always talk about risk. And when we're talking about risk, Lisa, we're nearly always talking about downside risk. But the number one question to ask over the last 20 years is, what's the upside risk?
Really?
What's the risk that things go right? That's been the most unappreciated risk.
It's true.
For much of the last decade.
But this is the way you're actually going to truly tweak me today, because this has been the real issue, and this is what concerns me. I know, and you succeeded, so congratulations. But to me, the idea that this has been the issue, people have missed out on the upside. How much becomes a Pavlovian response, where if in doubt, buy, right? And this idea that if you miss out, you will just keep missing out, because that's how it has been over the past 20 years. What breaks that paradigm?
Let's ask Brent Shuley now. We can do that with Northwestern's Mutual Wealth Management Chief Investment Strategist. Brent, your words, investors and the three camps they fall into right now, those worried the economy is growing too fast, those worried growth is peaking, and those worried stock valuations are simply too high. Are you in any of those three camps right now, Brent?
No, it was something we worried about. So we got to May or June, and economic growth was finally strong. COVID cases were declining, and we all sat around and thought about what is next. And I think as you've kind of been tweaking Lisa just a bit, people were worried about those three things occurring. That was where the worries were. We see each one of those subsiding as you move towards the end of the year, and that to us means a higher equity market led by more cyclical aspects of the market. So think value stocks, think small cap stocks, and think the Eurozone. And so we do think there's room left to run. It's just you've had this defensive versus cyclicals. Defensives have really won the day over the summer, but I think it's because of those three worries. And I think each one of those threes pulls back into the end of the year. And I think that's the impetus for the rally that we expect to occur.
Brent, let's try to put some quantification around how much room there is to rally. What kind of returns are you expecting, are you shooting for with the likes of a small cap bet at this point in the cycle?
Well, I mean, I think everything's less than it was before, correct? And so if I think back to last year, we went overweight equities with an uncertain outcome, but the opportunity set was so wide. I think about today, I'm a bit more certain about what the economy holds pushing forward. There are still, as always, uncertainties, but the opportunity set is smaller. And so I think about relative performance more. And I think small caps are set to outperform their large cap counterparts. And the Eurozone is set to outperform probably both of those. And so much, much more muted returns. But still, in the context of a 10-year treasury, as you opened the show at 132, 133, whatever it is today, stocks are still a relative valuation advantage towards bonds. And that isn't changing until the 10-year treasury changes. And that's still where central banks are impacting the most.
Well, Brent, I'm glad you brought that up, because we were having a conversation in the previous hour about big tech and how it was kind of unusual that we had record highs for the FANG stocks yesterday on a day when yields actually rose. But when we saw the low for the NASDAQ 100 this year, it was on March 8th, and the 10-year treasury yield was at 160 on that day. We are still 25 basis points below that. So can you make a case really against big tech if yields kind of stay in this range?
Yeah, I mean, I think it's more of an economic growth and what's keeping the treasury in that range. And so is it tapering? Is it distortion? Is it just a lot of liquidity around the globe? I just think the small cap and the cyclical trade to me is more tied to strong economic growth that I think people were worried about plateau or peaking. If anything, it's a plateau. You have companies with huge amounts of new orders, huge backlogs of order, and low inventories. You have consumers with incredibly strong balance sheets who've probably been pushed out just a bit because of what Delta has done. And so I think you continue to see economic growth that remains strong. I'm not for sure what the 10-year treasury does. I expect it to have an upward bias as tapering is announced. But I think all those things point to an economic cycle that lasts just a bit longer and is a bit higher for a while. And valuation, which I think many economic cycle investors are ignoring, still points to small caps and value stocks as being cheap relative to their counterparts.
Brent, you mentioned small caps over large caps. You mentioned cheap. A lot of people would say Europe cheap to the United States, and we've said that for a long, long time. You touched on the Eurozone and talked about the potential for outperformance there. What do you like about Europe, Brent?
It's much more cyclically inclined. And so the setup of the index is much more cyclical in nature. Europe's been cheap for a while. It was in need of a catalyst. It actually has that now. The central bank there has done things, quite frankly, that they hadn't done in the past. Germans have even gone on a fiscal spending spree. And so I just think that you have strong cyclical economic growth for really the first time in 10 years, to 12 years. And I think that's a backdrop for Eurozone stocks finally being appreciated by investors.
Brent, there's a column in The Telegraph by Ambrose Evans-Pritchard talking about how Germany does, though, seem to be losing patience with quantitative easing. They're starting to indicate perhaps they don't want to keep the pedal going for as long as they have for the foreseeable future. This really bleeds into the potential for taper talk tomorrow at the ECB meeting. If they were to start talking about tapering their QE, would that change your view on Europe?
Yeah, it's certainly a risk. And I think of the central banks right now as 3 yards in a cloud of dust. So sorry, Jonathan, just a different football game than you're used to. But they're advancing the ball slowly to try not to get any market reaction. And I think central banks around the globe, I think people need to stop focusing on their day-to-day operations and focus on their action function. And it's still to do more, not to do less. Certainly the Eurozone probably a bit less than the US. But in general, overall, central banks stand at the ready and will continue to do so until there's a cost on the other side. Right now, I know there's talk of inflation, but that cost is still relatively low. Interest rates are well behaved, and they've failed in their mandate for 10 years. They're going to push as hard as they can for as long as they can, as long as inflation allows them to do so. And I just think that as you move into the end of the year, inflation is going to pull back, and that taper talk and everything else is going to subside just a bit.
Is that football with the hands? I've not seen it before. They use the hands for that.
They use their hands. Yes,
Okay.
3 yards in a cloud of dust.
Okay,
Advance
wait.
the ball slowly towards the goal line.
Is this good?
Football.
Is this a good Tom Keane? It's an oblong round ball.
With the hands.
With the hands.
Brent, thank you.
With your hands.
Brent
Thank
Schuh,
you.
Northwestern Mutual Wealth Management Chief Investment Strategist. Just for those of us outside of America who might be confused by football with the hands. Lisa, you mentioned Ambrose Evans Pritchard, who's been writing the same article or a different version of it for the last 10 years plus.
Well, yes, and the headline is, Germany has lost patience with quantitative easing. That spells big trouble for Southern Europe. That said, there is a little bit more discussion from Germany that perhaps it's time to wind down some of the bond buying, and that isn't just isolated to Germany. And so you do start to wonder if they are going to have more of a conversation. But yes, I mean, look, I'm not saying that this is gospel, but it certainly is a risk out there to markets.
Sure, look, ton of respect for the man over at the Telegraph. The issue is for the ECB, it's unsaid, but most people assume that if you had a move in peripheral spreads, Lisa, that would set the tone for policy. It would be the ultimate circuit breaker. Yeah. And the same for the Federal Reserve. Are they really going to allow financial conditions to tighten aggressively over in Europe? Are they going to allow spreads to really start to gap wider aggressively?
Well, and this is something that you've talked about, is the policy response of the ECB simply to close the spread, close the gap between German and peripheral spreads. And so far, it seems like...
Well, we had a test of that last spring, didn't we?
Kind of has been, yeah.
President Lagarde came out and said it's not our job, and then the market said, well,
yes,
I think it is. But the biggest story, and it's a much, much harder one to sell, is that the ECB is no longer able to get what it wants with peripheral spreads. So they somehow lose control over what's happening there, and I think that's a much tougher argument to make.
Well, and we're not that close to that, it seems like.
As I say, a ton of respect for the man at the Telegraph. It's just the same story for a long time.
Just going to undermine it.
Yields in for 3 basis points. I'm just not going to promote it, that's all. There's a difference. There's a difference. We're staying neutral. 134.27 on 10s. The equity market is now negative about 0.1%. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. In the UK today, Parliament is expected to vote on Prime Minister Boris Johnson's call for $17 billion in new taxes on workers and companies. They will go towards paying for improved social care. Johnson's Conservative Party is traditionally against higher taxes, but the new revenue will help trim budget deficits bloated by the pandemic. In Japan, the government reportedly has told the ruling coalition it will extend the coronavirus state of emergency for 19 regions until September the 30th. That's according to NHK. The emergency covers Tokyo, Osaka, and 17 others. 2 other regions will be downgraded to less strict virus measures. Former President Trump has a strategy these days that's profitable. He frequently teases another presidential bid without actually announcing. That's left him with $102 million in donations, an amount that could scare off donors to other candidates. But by not declaring, Trump is free to use the money he's raised to act like a candidate without the restrictions that come with an announcement. Aluminum is inching towards its highest price in 13 years. The coup in Guinea is one reason. The country is a major supplier of bauxite, which is used to make aluminum. That's added to uncertain supply outlook just as global demand booms. What was assumed to be Apple's next big thing is suddenly in doubt. The company's top auto exec, Doug Field, has left to become Ford's chief advanced technology officer. Apple has been developed a self-driving car. Field is the 4th exec to leading the effort to step away in the unit's 7-year history. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
somebody said, I want to be the next Reid Hoffman, what would you say is the best training ground to do that?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself.
What do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this accompanying surge in deaths as well.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Markets are in a tough place, especially the U.S. market is in a tough place over the next 60 days. I think you have a period where we think the growth data in the U.S. is going to look quite weak in September. A lot of that weakness might actually be a little bit in the rearview mirror, but the weak data will get reported in September.
Andrew Sheets of Morgan Stanley, underweight U.S. equities, still liking what he sees over in Japan and in Europe. From New York City this morning, good morning. Alongside Lisa Bravis and Katie Lyons, I'm Jonathan Ferro. Tom King back with us tomorrow. Your equity market shaping up as follows. Bit of price action creeping downwards in the equity market. We're down a little more than 0.1% on the S&P. Similar move, in fact, the exact same move on euro dollar, 118.25, down a little bit more than 0.1%. A weaker euro. Outside of that, into the bond market, yields come in 3 basis points, erasing some of the move higher over the last couple of days, 134.44 on 10s right now. So let's talk about the China story, shall we? Mr. Dalio, Ray Dalio, in a Bloomberg Radar event saying the following: it's a part of the world that one can't neglect, and not only because of the opportunities it provides, but you lose the excitement if you're not there. Damien Sasser of Bloomberg Intelligence joins us now. Damien, there's been some excitement over in China, that's for sure. Let's talk about what's happening in credit right now.
Yeah, no, we've got to focus on Evergrande, right? The largest property manager in terms of debt outstanding in China, and effectively downgraded now by Fitch and Moody's to CC, which basically puts it in default, all but puts it in default. But what's most interesting is you got $13 billion in cash on hand, $37 billion of payables due over the next 12 months. And the company's just announced that they're going to be suspending interest payments on bank loans that are due on the 21st of this month. So effectively, the default is in the works, Jonathan, and that is not a good thing. And we see the spillover to a number of the other property managers in China credit, specifically Guangzhou RNF, Yuzhou, and Fantasia. You know, all of those bonds trading at a significant discount to par. In the case of Guangzhou, it's something on the order of 50% discount to par. Nowhere near Evergrande, which is trading at 25 cents on the dollar, but nevertheless, you're starting to see some spillover there.
This is a centrally planned economy. Damien, the questions you ask about what happens in China, they're not questions you typically ask in other countries. Your experience looking through the EM lens right now, what are you looking for from the policymaker?
Well, I mean, we have total social financing out tonight. We expect a lot more credit to be injected into the Chinese market, probably 3 times what we saw in the month of July. But, you know, we're looking for spillover. We're looking for contagion effects. And so we're looking at demand for construction materials, home appliances, furniture in China, because that's probably going to get hit on the back of all the weakness we're seeing in the property sector.
Although the market is increasingly international, and I do wonder when we talk about contagion, how much could potentially be the Archegos effect, the idea that people could be levering investments in, for example, Evergrande bonds or stocks, and then also investing in other securities that they're going to have to liquidate in order to make good on those losses. Is there anything even close to the sign of that type of occurrence?
Well, now you're talking my language, Lisa, because we have to disregard everything from Moody's and Fitch, and we have to focus on CCIC, which is the leading rating agency in China, which downgraded Evergrande bonds last week. What that did is it made the bonds ineligible as collateral to be used for leverage by banks in China, in the interbank market. So you're absolutely right. You know, I mean, there is no, I mean, you and I have no idea what the extent of leverage is in the interbank market in China, but that's exactly what we're focused on. I mean, it happened very quickly, and now we're seeing the price impact for sure.
And Damien, you've been in this market for years. You have a lot of contacts trading. What are they saying in terms of pressure points, in terms of the pace of some of the market moves, in terms of signs of this leverage being unwound from the system?
Opportunity, Lisa. I mean, look, this is nothing new for emerging markets. You know, you wait for these opportunities when regulatory political risk is heightened and the bonds sell off to this extent. You know, you're going to see distressed investors start to step in here probably and start to pick up some of these bonds at deep value. I mean, but look, you know, there's difference between, I mean, there's structural subordination going on in the Evergrande bonds. There's OpCo HoldCo issues. There's, you know, the fact that the company may be able to actually get some assets disposed off its balance sheet. So look, there's a lot still out there for distressed managers to look at and take advantage of. And that's what I think they're going to be focused on.
But when we talk about the pursuit of common prosperity more broadly in China, does that mean a Chinese state that is going to be more tolerant of distress or failure?
Probably not, right? I mean, well, look, I mean, the verdict is out, right? I mean, I think Dan Fan, who's my chief China real estate credit analyst based out of Hong Kong, you know, he believes that, you know, this is nothing new. You know, there are comps for this, you know, that basically these bonds are trading with value now. I do think this is different. You know, I have to agree that, you know, despite, you know, everything George Soros said, I mean, he's 91 years old. We have to take stock of it. You know, there is room for concern here. I have to agree with him. But look, you can't ignore China. I mean, look, the value discount on some of these bonds and quite frankly on China local government bonds isn't to be ignored. And especially in a world where, you know, real yields are declining / negative in developed markets, that's something that, you know, we're looking at and something that I think investors need to take stock of.
So Damien Sassower citing maybe more on the Ray Dalio side of things, but when you're trying to make an investment case in China, is it greater the regulatory risk or the economic slowdown risk?
I don't think you can really kind of weigh one more than the other, but I mean, for me, it's not going to be about the economic slowdown. I think actually the growth fears are overdone globally. I think that's why you're seeing this liquidation of the reflation trade across emerging markets. And again, it's this crowding in effect. It's countries like South Africa, Brazil, the commodity producers, which stand to benefit from this. So really, it's about picking your spots. I hate the I word idiosyncratic, but that's exactly what we're talking about here in China.
Just quickly, who owns this debt?
Oh, yeah, that's a great question, Jonathan. A lot of people think it's Chinese corporates and China Inc. that really owns the bonds for a lot of these.
Interesting.
Yeah. No, I mean, we don't have a lot of holding data, which is something that, you know, we are working on. But, you know, suffice to say, there's certainly a lot of benchmark following index investors, ETF investors, where this debt is finding its way into its portfolios and certainly having an impact.
Just trying to understand how much of a black box this actually is, Damien.
Yeah, it's pretty black, Jonathan. I wish I had my black suit on today, but I can't tell you.
Damien, thank you, sir. And isn't that a complicating part of all of this, Lisa? Damien Sassower, thank you. That we really don't know a lot here, Lisa.
Yeah, we don't know who owns it, and we don't know what their other positions are, what the leverage is on that, especially if they can't post some of these bonds as collateral. I mean, again, it goes back to the issue with family offices that we saw a couple of months ago. Who will be exposed? What was it Warren Buffett said? When the tide goes out, you see who's naked. Here we go.
We just don't know who that is yet. I've never really liked that particular quote.
I know, I could tell you're just sitting here trying to figure out how to sort of censor yourself what you want to actually say.
I was just going to do what I always do, which is hit the market. Can I do that now?
Sure, go ahead. How are those markets doing there? Are they scintillating?
Pretty boring, to be honest with you, Lisa.
Well, let's look at them anyway.
-5. We're down a little more than 1/10 of 1%, 134.61. We're down 3 basis points on 10s. Look, Lisa, on a serious note, do you think the Archegos routine, what we went through, the process, the episode, do you think that's a decent analog for what's taking place here?
I don't think that they're, I mean, Damian Sassower was saying that they're looking for it. We're not seeing it necessarily, huge pockets just being pulled out from the market. However, whether we've reached that trigger yet is unclear. I mean, again, I don't know, and frankly, I don't even know enough to say I know or I don't know, but I do think that increasingly the more international the world becomes, and the more you get the likes of Ray Dalio increasingly investing in China despite all of these regulatory concerns, the more you're likely to get some of those pockets that we saw with Archegos.
Damien knows that when the I word gets used, we get a little bit nervous, Kaylee. Idiosyncratic.
Added to the list, barbell, idiosyncratic. What else?
Is anything truly idiosyncratic in EM? Doesn't it just become a broader EM story eventually?
Fair question. I think with China, it becomes a little bit harder for China to be idiosyncratic, just given how heavily a weighting it has in EM, John.
You're saying that they're all the same? No. They all, the idiosyncratic works. I think it's fair.
I mean, from a market's perspective, collectively, at the index level, all of that good stuff. I'm not wound up. I'm so cool, calm, and collected. Totally zen this Wednesday.
When's the book coming out?
Soon. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Cannabis remains very strong even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
from New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Lisa Bramett and Katie Lyons. I'm Jonathan Ferro. TK back with us tomorrow. Here's your equity market on the S&P 500. He is not missing much. We're down 6 on the S&P, negative a little more than 0.1%. I know I'm underselling today a little bit. We'll get into that in a moment. Yields are lower by 2 basis points on 10s to 134.95. Lisa touched on the debt supply a little bit earlier this morning. $38 billion of 10-year notes coming at 1 Eastern. At 1:10 Eastern, the Fed's John Williams, the New York Fed President John Williams, will be speaking. Then Mr. Kaplan of Dallas speaking at about 6 p.m. And on the debt supply side of the story, it's not just the sovereign side. I've talked about that 10-year note issue, $38 billion worth. We've got a ton of investment-grade debt coming as well. And crossing the Bloomberg terminal, Walmart kicking off their debt sale as well, Lisa.
The idea here is that there's a record pace of sales in the day after Labor Day, which is typically an active day. We had the greatest number of issuers ever come to market yesterday. And why wouldn't they? This is the best time you could ever imagine. Borrowers are flush with, have good balance sheets. They can borrow at record low rates. And investors are flush with cash. I mean, John, it makes sense. And my question is, when is this a warning signal versus something that looks terrific? Why not borrow if rates are low?
You went there, didn't you? You said it. You said borrowers have good balance sheets.
They, for the most part, they have been actually delevering or at least reducing their borrowing costs for the longer term. You know, how long that continues, if you see the M&A activity picking up, we'll see.
Did that hurt a little bit?
It did, a little bit. Well, I mean, it's so much debt, and you do wonder, is there no consequence?
Well, there's an easy story to spin, right, that they're trying to get ahead of the story on September 22nd. But as you say, typically, Lisa, this is a busy period for issuance.
Yeah, I mean, everyone was expecting this to be a busy time for issuance, and actually some of the weakness that we saw in August in the corporate debt space was because people were reserving cash to buy this flood of issuance that we're seeing now.
Amazing story over the last, really it's the last 18 months, isn't it?
20 years.
Yeah, well,
I mean, let's go further.
To be fair.
Come on.
Joining us now is Don Rismiller, Strategas Research Chief Economist. This is a conversation Lisa might prefer. The S word, Don, is getting thrown around a ton. Stagflation.
Yes.
Walk me through it.
So it's understandable that it's coming up at this point. We've had to take our GDP forecast for the third quarter down. Some of that is on the demand side. Some of that is on the supply side. So we saw consumer confidence fall in both the University of Michigan and the Conference Board survey. We saw the payroll employment report come in weaker than expected. We've also seen some auto production cuts. We have problems in the supply chain that are lasting. At the beginning of the year, the idea of supply chain problems was something that was assumed to be temporary, and it still probably will be temporary. We assume supply shows up both on the goods side and on the labor side. But we might need another word as we go into months 9 and 10 and 11 of this story. And so we have slower growth, and we're looking at price increases in homes, in cars, in other areas that are getting stickier. We're also starting to see rents turn within the price data, both for the CPI and some of the other measures that central banks might watch, like the PCE. And that's the type of inflation, rents, wages, that we want to think about when thinking about stickier, lasting inflation.
Don, let's talk about a word and what goes into a word. Are you comfortable with this word, stagflation? You touched on it a little bit. Next year, GDP growth could have a 4 handle. That's not stag, is it, in a stagflation? And if we're looking at decelerating growth, and that's what it is, decelerating growth and maybe persistently higher than expected inflation, is there a better word for that?
Yeah, we've tried to call it a stagflation scare here in the third quarter. And I think if you emphasize the word scare, you're getting the right context. This really isn't the 1970s where the stagflation word was popularized. And so if we think about the 1970s, in order to compare prices, you had to load the family in the station wagon, drive around, bring your pencil, write down the price, drive back home, get your calculator out, compare prices from different stores, and hope you didn't spend more on gas while doing that. So it's not that type of environment. There are factors that are very strong on the disinflationary side, the ability to compare prices instantaneously on your device, globalization, technology, competition. These are all still operative. So we don't have to take that picture from the 1970s and use the word itself that was applied to that period. But the idea that there's a scare that is still to be appreciated, especially in this third quarter data, the very short term.
Yeah.
I think that's relevant.
There's also the possibility of optimism around a good inflation. And I look at the wage data in particular, the idea that the average reservation wage, the amount that people ask for when they first start a job, actually rose substantially year over year. The Atlanta Fed wage tracker, we can actually see that the lowest income earners are doing the best when it comes to how much their wages are going up. Isn't this positive? Doesn't this give you some hope that perhaps it's not going to be stagflation, but just inflation?
So there is an argument to be made that the inflation target at around 2% was too low. And so the fact that we've hit the zero bound on interest rates over the past decade and stayed there in many cases in many countries would say that maybe we should be thinking about tolerating a little more inflation when it comes to managing the economy, given how central banks act. Now, if we wind up slightly above 2%, for, let's say, several years, that's probably okay for the economy. The question is, are markets priced for that? If transitory at the beginning of the year meant we're above target for a couple months because of some disruptions, because of some pressures on reopening, that can pass pretty quickly. If transitory now means 3% inflation for 3 years or something like that, then I think we have to compare it to what, say, the bond market is pricing in.
Sure, and a lot of it does come down to the labor market and whether it's too tight or tighter than people expect, or whether there's a lot more slack than people currently are looking at. What's your view on that?
So there have been a number of issues with labor force participation in the last year and a half. So obviously the health concerns which have resurfaced in the past 6 to 8 weeks with new virus variants are still in play. There have been issues with childcare that play into some of those health issues, but also form a general commentary that the pieces of the economy are not fitting together as well. So that's really the supply chain issue on the labor side. And then we've also had additional benefits that have been provided. Those have ended. And so to the extent those factors have changed the labor supply picture, there has been a hesitation on the participation rate. We're not done with the health issues. We're probably not done with some of the childcare issues. But the assumption has to be over time, labor supply shows up, and that will matter for slack in the labor market and the ability to grow again. So it's not to say that wage increases are always a bad thing. They have to be matched with productivity increases, though. And the good thing over the past year is we've had some wage gains, but we've also had productivity gains. And that matters. That means unit labor costs stay down, and then you have profits growing and wages growing. And that's the good scenario.
Don, you said that we're not done with some of these issues, and that could mean that the data picture is still cloudy and messy as we move forward. Can the Fed make a move in that environment?
It certainly makes it harder. So if there was a case to be made for a September taper, that's probably off the table after last week's jobs report. But the jobs report wasn't wholly bad. The unemployment rate came down. The household survey was stronger. So if you wanted to dig into the details, you can still see a labor market that looks like it's in the process of healing. That process was interrupted in August. It's probably going to stay somewhat interrupted here in September. But as we move into the fourth quarter, what the Fed is talking about doing is tapering QE. That's taking a tool off the table that still might not be appropriate. Even if we think the economy needs some help, additional QE at this pace may not be the right tool. So I still think there's room to have that discussion over the next several months.
If it's not the right tool to address some of these issues, then what difference will it make when bond buying does start to be reduced on a monthly basis? What tangible?
So when we look at the past decade, the consideration of this has led to bond tantrums. Now, we've gotten through this year without a major bond tantrum. So the issue with QE is it provides some credibility to forward guidance. So as long as the Fed is buying bonds, investors seem to be willing to give the Fed the benefit of the doubt when they say they're not going to raise interest rates. And so the challenge for the Fed is to change the QE position, change the pace, taper, without starting the clock on tightening, because it may not be the case that the economy is robust enough to put your foot on the brake. You just want to take your foot off the gas in this world that we're talking about here. And so splitting, tapering from tightening, changing how that clock has worked, creating credibility for forward guidance, even without bond buying, becomes the issue for the central bank.
That's the goal, the target, the objective for the chairman at the moment, that's for sure. Don, thank you. Don Rissman there, Strategas Research Chief Economist. At the top of the hour, Mandy Zhu, Credit Suisse Securities. These strategists will be joining us at 9 o'clock Eastern Time for the Open. A conversation you don't want to miss. Here's a tease of it. Mandy thinks that the risk that is underpriced is upside risk. Upside is underappreciated. With all the focus on potential downside risk, we think investors may be underpricing the right tail. Lisa, that conversation coming up in about 20 minutes.
On the flip side, you have, for example, a Goldman Sachs managing director coming out and saying high valuations have increased market fragility. People concerned about that, and maybe that's the sort of tempered bets that she sees getting blown out in terms of the upside risk, considering that there still is some hesitance out there.
It's the question we always ask, isn't it? Katie, can we climb the wall of worry?
Well, we have so far this year, John. That's the thing, is that the bias to this equity market very clearly is to the upside. That is evident in that we could be heading now for 212 days without a 5% pullback, and we've seen 54 records on the S&P through now September 8th, and we still have about 4 months to go through the end of the year. So to this point, John, there is no reason to believe that the equity market can't keep climbing the wall of worry.
Keep counting, Kaylee. It seems
Always.
we're down 5 on the S&P. I know you will. The S&P negative a little more than 0.1%. In the bond market, yields in 2-3 basis points on 10s to 134.61. I'm going to run. Katie, thank you for the last couple of days.
Thank you.
A man with a bow tie and a very husky voice will be back with us tomorrow. I cannot wait. I'm being genuine, Lisa. Don't look at me like that. I'm being real. Very
not saying
authentic.
anything.
Cannot wait. Dow's down 43. Much more of that still to come tomorrow.
Yeah, I'm
This
sure.
is Bloomberg.
With the First Word News, I'm Rishka Gupta. In California today, opening statements are set in the criminal trial of Theranos founder Elizabeth Holmes. She faces federal charges of defrauding patients and investors with claims of a revolutionary blood testing process. At one point, Theranos was valued at more than $9 billion before questions arose about the technology. China has moved to complete its purge of Hong Kong's election system. New rules make it all but impossible for opposition lawmakers to return to the city's legislature. In the last 10 months, over 300 elected legislators and district councillors from pro-democracy groups have resigned or been removed from office. Tesla's shipments of China-made cars to the local market rebounded last month. Elon Musk's electric car maker reported domestic China shipments rose almost 50% from July, when they had plunged 69%. Exports from Tesla's Shanghai factory, most of them headed for Europe, also rose. JP Chase is extending its services further into the auto industry. It's acquiring closer to 75% of Volkswagen's payments platform. Terms of the deals weren't disclosed. The VW unit offers customers the option to use digital payments for car purchases, fuel, parking, and other services. JP plans to work with VW to develop new markets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
I think that China is going to have one very strong creation of the technological future. It's one of the reasons why in blitzscaling we call it the land of blitzscaling. I think Silicon Valley has some edges too, but I think it's very much of a game-on circumstance.
Reid Hoffman, Greylock partner and LinkedIn co-founder, speaking on peer-to-peer conversations. You can watch the entire conversation tonight on the David Rubenstein Peer-to-Peer Conversation show, airing at 9 p.m. tonight Eastern Time. And of course, joining us now is the man himself, David Rubenstein, the co-founder of the Carlyle Group, and of course the host of this fantastic show. Reid Hoffman, a really important person to be talking to at this moment, where we see this tech battle really heating up between the U.S. and China. Where did he sort of throw his hat in terms of which region had the upper hand in this tussle?
There's no doubt that the Silicon Valley has had the upper hand for decades, but he does think that China is now competing effectively with the United States. And you have these two polar opposites in effect, China with one system for entrepreneurial activity and Silicon Valley with another. And he thinks that China is doing what he calls blitzscaling, which means building very large companies. That's what's happened in the United States with Amazon and Apple and Netscape, very large companies that operate at scale. And he thinks that China is doing the same thing.
Well, that's the bigger picture, and yet the micro picture has been an increasing crackdown on some of these behemoths and some of the blitzkrieg companies, or the companies that have benefited from their approach. How does he view that? I mean, does he believe that that will foster innovation, or that potentially put a damper on it by raising regulatory uncertainty?
Well, clearly, China wants to make it clear that the Chinese government is the most important thing in Chinese society. And once the entrepreneurs recognize that, they can go about their business. But clearly, China doesn't want companies that are more powerful than the president of China, or their entrepreneurs being more powerful. So they have had some kind of crackdown or regulatory constraints. We haven't had quite the same thing in the United States. So the American entrepreneurs are freer to build companies without the kind of constraints and concerns that now some people have in China.
Well, talking about building companies, David, it's Kaylee Lyons in New York. Good morning to you. You mentioned there Apple, Amazon, these behemoths we have seen grow here in the U.S. Does he believe that those companies are getting too large?
Well, he doesn't say that, in part because, remember, he is a person, I think he's still on the Microsoft board. He sold LinkedIn, which he built, to Microsoft. So it'd be difficult for him to say that Microsoft is becoming too big and too powerful. So he doesn't really say that. He does say that we now have 5 of these gigantic technology companies in the United States, and we're going to get 10 of them soon. So a company that, like, say, Salesforce will become one of those kind of companies, or Netflix will become one of those kind of companies, which they're big now, but they're going to be much, much bigger. So he doesn't worry because he thinks there are going to be more and more of these gigantic companies, not fewer and fewer of them.
And are those the kind of companies he's interested in getting into now, or what would he favor?
Well, he's a venture investor. He's at Greylock, a very good venture firm. He's an entrepreneur who built LinkedIn and helped to build PayPal, but he's also a venture investor. He was an early investor in Facebook, an early investor in Airbnb. So he likes to find young entrepreneurs who are really talented, have a good idea, and back them. So he's an unusual mix of both being an entrepreneur and a venture investor, and a very successful angel investor as well.
David, yourself also being a pretty big investor in companies at the earlier stages, there is a question of what the structure of such dominant tech behemoths at the top does for innovation for some of the smaller companies. In other words, how much of a competitive advantage can they have, and how much can they get with respect to data, which reigns supreme?
There's no doubt that the large technology companies now have a lot of data, and they're using it, they would say, for their purposes, their corporate purposes. But there's always going to be entrepreneurs, always somebody with a new idea, somebody that is very creative. And he likes to back people who he thinks have a vision of where they're going to go and have the capability of getting there. And it's a different skill set than being an entrepreneur, where you have to have the vision yourself and build a company. But Reid Hoffman is a very talented individual, and when he's in the room, it's pretty clear he's always the smartest person in the room, but he doesn't tell people that. And so he has a certain modesty that I think reflects the fact that he's very secure in who he is, and he's very well respected by his colleagues. Lots of times you have very bright people, and behind their back, people are snickering about them because their ego's too big or they're not as talented as they think. That's not the case with Reid.
David, I want to bring the conversation back to where we started, and that is China. We've heard a chorus of large name investors over recent weeks kind of weighing in on the debate on whether or not you can invest there. You have George Soros on one side saying that would be a tragic mistake. You have BlackRock and Ray Dalio on the other. I'm just wondering what your take is on China, given the crackdown that we are seeing.
I think George Soros's point had to deal with geopolitical issues and government constraint issues and things that are different than whether China is going to build companies that if you invested them, you'll do well. As a general rule of profits, you have to get comfortable with some of the constraints you have in China, but there's no doubt there are constraints in lots of countries as well. So I wouldn't say that China is not a good place to invest. I think it's a very good place to invest, but there are some challenges you have to get comfortable with, and you have to get comfortable that some of the governmental actions are not going to be ones you might be comfortable with if they were happening in this country, for example.
Has your shift focused at all with respect to your appreciation of China investments, even with Xi Jinping's recent pronouncements around the common good?
Well, right now, you have to remember, China has 1.3 billion people, and it's going to be a gigantic market for some time. But the Chinese governmental system is different than Americans, and you have to get comfortable with that. And so if you're not comfortable with that, then you can invest in many other places. But if you're comfortable with the fact that China is going to have a heavy regulatory hand in things, you can get comfortable with investing there. We have invested there. I have invested there. I'm not pulling out of China. I think it's actually a very good place to invest. But every country has its challenges. The United States has challenges too. You can't argue that we have all the kind of governmental actions that everybody is comfortable with here either.
David Rubenstein, you make a very valid point. Nobody would disagree. David Rubenstein, host of Peer-to-Peer Conversations on Bloomberg Television, co-founder of the Carlyle Group. Don't miss that at 9 p.m. tonight. Reid Hoffman, an entrepreneur who helped co-found LinkedIn, speaking about the landscape for technology at a time when it really is preeminent. And Kaylee, you just think about how much money has been raised for some of these venture capital funds and others to get into the tech dominance that we are seeing everywhere in the world right now.
Yeah, we talk a lot about the wealth creation in China, Lisa. The wealth creation in Silicon Valley, nothing to sneeze at either.
Yeah, and frankly, it has been with the dynamism of growth in America, and it has been the backbone of it. Coming up on Balance of Power, Senator Rick Scott of Florida and Congressman Sean Maloney of New York to discuss how to, frankly, open schools, mask mandates, and all the controversy. I'm sure that will be incredibly exciting. It'll be fun to pit them against each other. Right now, we're seeing a little bit of softness in the market as we head to the open. This is Bloomberg.
I'm Danny Kleppinger with an exclusive U.S. Open update for Bloomberg TV and radio from Tennis Channel. The teens continue to take over at Flushing Meadows on day 9 in New York City. Just a day after her 19th birthday, Leylah Fernandez survived a late comeback from the #5 seed Alina Svitolina to reach her first career semifinal at the Slams. After taking out defending champ Naomi Osaka and three-time major winner Angelique Kerber, the Canadian fired 42 winners in her third victory over a top-5 opponent, to the delight of a packed house on Arthur Ashe Stadium. Fernandez is the youngest woman to reach the Final Four in the Big Apple since an 18-year-old Maria Sharapova made the semis back in 2005. And don't forget, you can watch all the action from the Open every night on Tennis Channel. I'm Danny Kleppinger.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's a quiet Wednesday morning for our audience worldwide from New York City. Good morning, good morning. Your equity market not doing much. Futures slightly negative. 30 minutes to go. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York, we begin with the big issue. The return to normal delayed, not derailed.
Things are almost back to normal.
But real economic activity is getting a little bit weaker.
A lot of companies are starting to
push back that back to office.
Major corporations have certainly pushed off their kind of full return to office.
There was clearly some slowdown.
Sort of a recovery delayed but not derailed.
The Delta variant is going to be a risk.
Probably delays it.
But I don't think it's going to completely derail it.
I don't think it's derailed.
Demand shouldn't wane.
We still have a healthy trajectory ahead of us.
It's just delaying growth. We anticipate a much better 2022.
The underlying recovery will continue.
We're going to have to wait a bit longer.
Let's get to the panel. Wells Fargo's Michael Schumacher and Barry Knapp of Ironsides. Let's just start with that debate right there. And Mike Schumacher, first to you. A recovery delayed and not derailed. Does that resonate with you, sir?
That sounds right. But the thing is, Jonathan, and we've seen this over the last 18 months, you can't really forecast the evolution of the COVID variants all that well. So to date, if it's only Delta and you've got booster shots coming out really starting in a couple weeks in the US and in other countries, perhaps it is delayed by a couple months, but still quite a bit of uncertainty out there. So it resonates, but still our confidence is somewhat low.
Barry Knapp, same question to you.
Yeah, ironically, although I do think we're due for a correction and I'm concerned about this peak growth dynamic, I actually think that further delay is going to further accelerate the positive productivity effects of the pandemic, right? So more people working from home, more flexible workforce. In a way, this mobility of the workforce is the antithesis of what happened after the global financial crisis. So I don't view this as a net negative in the intermediate term. Obviously, it's a negative in the short term. It's negative for people involved. But in terms of this being a positive productivity shock, it could actually further help that process.
Barry, when you say it's not a net negative, do you say that from the perspective of a market participant or someone looking at the economy?
A little bit of both, right? I mean, if you think about what the global financial crisis did to productivity, it was a negative productivity shock. This one was in a lot of ways a positive productivity shock. It accelerated trends like substituting capital for labor, delivering services, even healthcare in a much more efficient way. The work from home dynamic, which, in the aftermath of the global financial crisis, people were trapped in their homes with negative equity, couldn't move and go find jobs as the economy was adjusting. This go around with the work from home process, you've seen Stephen Davis's report perhaps that said we're going to go from 5% total hours work being done remotely to 20. That kind of thing increases the mobility of the workforce and makes the economy more dynamic over time. So that's kind of what I'm getting at in terms of what the Delta variant has done.
Barry, I hear you, but it's probably not good for the airlines, and it's not good for the Delta Airlines CEO, Ed Bastian. He said the following on this whole conversation about it being delayed. He spoke to the Wall Street Journal. This summer, we were roaring back with a lot of growth across all of our segments, but about 4 weeks ago, things started to show some signs of pause. It's probably put a 90-day delay on some of the growth we were anticipating. For more on this, let's get across to Bloomberg's Katie Greifeld. Morning, Katie.
Good morning, John. Well, the mood music definitely darkening on Wall Street as those variant fears spread. Just in the past day, Morgan Stanley downgraded U.S. stocks to underweight while staying neutral on global equities. Citigroup, too, warning of a correction ahead, citing a buildup of long positions, with bulls outnumbering bears 10-1, even as the Delta variant spreads. And you can really see that pessimism at the office level. As of August, just 23% of New York City workers were back at their desks. That's just 13 percentage points higher from March. And John, just 41% of workers expect to be back by the end of September. That compares to 62% of respondents in May's survey. And consumers also starting to grow cautious. The University of Michigan Consumer Sentiment Survey hit its lowest level since 2011 at the end of August. That coincides with a rise in the U.S. COVID curve, with U.S. new cases now at the highest level since about February, John.
Katie, thank you. Katie, thank you very much. Katie mentioned Morgan Stanley. This is what Andrew Sheets had to say as he cut equities to underweight. He said the following: "We continue to think this is a normal cycle, just hotter and faster, and our cycle model remains an expansion. But the next 2 months carry an outside risk to growth, policy, and the legislative agenda. We lower U.S. equities to underweight and prefer stocks in Europe and Japan." I want to turn to Mandy Zood from Credit Suisse on this. Mandy, there's reasons to worry. Everybody's piling in with reasons to worry. You think perhaps the most underappreciated risk right now is actually upside risk. Mandy, why?
So I think in terms of downside risk, to your point, everyone's, well aware, everyone knows, what is coming in terms of, legislative, in terms of the virus trends, the risks. And that is exactly what is being reflected in the derivatives market. So what is really notable is that despite the decline in volatility, right, with the VIX now back to the mid to high teens, other aspects of the option market show extreme signs of caution. So one measure that we look at is called skew, which measures the relative demand for downside puts relative to upside calls. That measure is at or near record highs across a number of U.S. indices as well as European indices. And that just tells you everyone is focused on the downside risk. Everyone's focused on hedging. Not many people focus on potential upside risk. And now, to be fair, and it's not our main scenario, but we do think kind of what is cheap, what is attractive right now is looking at upside in a lot of the cyclical sectors, given the decline in volatility, given the cheapness of the calls. So looking at upside in financials, industrials, going into year end, I think that is a good risk reward trade right there.
Amanda, you and I are going to build on this through the opening bell. Mike Schumacher, I want your thoughts on that. The risk that actually things could go right. They could be okay. They could be better than expected.
Interesting take. And I think one way to consider this, John, is to focus on the central banks for a minute. So one sort of interesting impact of, let's say, Delta and COVID is probably makes central bankers a little bit more reluctant to tighten policy. Now, there's a lot of speculation, of course, about the Fed tapering. We think that's almost certainly not going to happen in September. November is questionable. Perhaps if COVID gets a bit worse, it's pushed back until December. ECB, we think, is frankly unlikely to taper this week. I know that's not a consensus call, but still, the point is you could have policymakers really adding a bit of fuel to the fire. And if you focus on what's really driven equities over the last year and a half, it's been incredibly supportive policy on the fiscal and monetary fronts. So maybe in some odd way, having a bit worse situation with respect to COVID does keep the central bankers in play and helps risk assets.
Mike, you mentioned the ECB and the Federal Reserve. We heard from Jean-Claude Trichet, the former ECB president, a little bit earlier this morning. Take a listen to what he had to say.
We are in the different universe, it seems to me, in the US and in Europe. In the US, you had a commitment to purchase exactly the same amount every month, and this is a clear-cut commitment. So tapering means something. In Europe, there is flexibility.
Mike McKee joins us now. Mike, the ECB tomorrow, the Federal Reserve on the 22nd.
Yeah, and the ECB, a better bet to do something. There is some suggestion, as Mike Schumacher was talking about, that the ECB might taper even if they don't taper. I'll explain what Jean-Claude Trichet means in just a second. But here's where the debate is. Are you a headline guy or are you a core guy? Headline inflation in Europe, 3%, much more than the normal under 2% that they've had for years and years. But look at the core is still restrained, and the ECB's hawks and doves are kind of divided along that line. There are two asset purchase programs in Europe, unlike in the United States. The Asset Purchase Program, APP, since 2014, they tapered once but reinstated it. Corporate public sector bonds, asset-backed securities, covered bonds. And then there's the Pandemic Emergency Purchase Program that they put in place in March of 2020. They've increased it twice. It's 1.85 billion euros. Same assets, including Greek bonds, which aren't available in the APP. But there is flexibility in how they do it. The capital key for APP, but they can do more than the capital key on a short-term basis in other countries. And that sets the stage for what they may do. Now, the U.S., the Bloomberg economics people think that the new framework that the ECB adopted at its last meeting will mean they really can't taper because they expect interest rates, they said, to remain at their present or lower levels until inflation reaches 2%, well ahead of the end of its projection horizon. Well, their projection horizon in June was 1.9% for this year, 1.5% for 2022, and 1.4% for 2023. Expect those numbers to go up, but that's not the 2% they're looking for. So here's what may happen and what Trichet is talking about. You look at the white lines is the APP, the yellow lines is the PEP program that they've added on, and they've accelerated PEP purchases. Well, they can cut back on PEP purchases first, and then they can cut back on the APP or let the APP fill the gap. And they're still putting out there about as much. It just comes from a different program. But if they stop accelerating PEP purchases, it'll seem like a taper to some people, even if it's not.
Mike McKee, the ECB's been a snooze for a while now. Should we actually pay attention to that news conference tomorrow? I've got to carry it tomorrow morning on this show. Should we pay attention to it?
I suspect we should, not just because of any announcement about PEP, because it's obviously not going to make a huge amount of difference in terms of the quantity of bonds purchased, but for what Christine Lagarde may say about their future plans, whether they're going to continue to accelerate or whether they are going to start cutting back, and whether they think inflation is going to rise significantly.
There's your promo. The news conference in full on Bloomberg TV. Mike McKee, thank you. Mike, thank you very much. Barry Knapp, I've said it a couple of times this morning. I was almost embarrassed carrying that news conference over the last several months because nothing was going on. Now we're having a conversation about taper here, taper there, taper everywhere. Mandy Zhu made a couple of points, and Mandy, I'll return to you on them in just a moment. That maybe the risks we're talking about, tapering, widely appreciated. Maybe there is a positioning story we've not quite acknowledged. The exposure to downside risk is actually, it's there, it's happening, it's been building. Barry, you've made the point that tapering is not priced at all. Why are you making that point?
Well, it does have to do with vol, but not equity vol. I totally acknowledge what Mandy said, and downside skew is definitely bid in equities. But in rates, we're looking at the vol index, you know, a standard deviation below its long-term mean. The most persistent effect of Fed purchases of agency mortgage-backed securities is to suppress fixed income vol. The single biggest source of fixed income implied vol is mortgage prepayment risk. The Fed doesn't hedge it. When they buy 100% of the net supply of agency mortgage-backed securities, don't hedge the vol, they drive fixed income vol down. It's incredibly cheap. Real rates are close to, although they've moved 20 basis points off their early Aug low, they're still near all-time low levels. That part of the fixed income space isn't priced either, and that has to do with the Fed buying 100% of supply of TIPS. So those two aspects, which are really technical factors that, you know, the Fed can't talk their way out of those things. When they slow the buying of TIPS and slow the buying of agency mortgage-backed securities, you're going to have real rates or TIPS yields spike, like in 2018 when they were unwinding their balance sheet, and you're going to have vol go up, like in January of 2018 when you had that big vol spike that just permeated out across asset classes and swept equity, vol significantly higher. So those two things are really unhedgeable. And when they get started, and I still think there's a pretty good chance they will in September, notwithstanding the headline miss, because every measure of slack actually tightened in that report on Friday, then we are going to have this effect.
Mike
It's going to be a vol spike.
You're the bond guy. What's your reaction to what Barry just had to say?
Yeah, I take a little different perspective there, John. It's interesting. If you look at fixed income vol, yes, it's down, but it's down a lot in the last 3 to 4 weeks. And that is not, at least in my judgment, any reflection on the Fed's monetary policy with respect to tapering. What it is, though, is that people out in the markets are saying, hey, the Fed's probably going to stay away from a while, from tapering, that is. So therefore, we've got a green light to put on carry trades. We can go out and sell volatility. We can extend a bit farther out the curve. We can do that sort of thing. So we've had lots of investor flows in which people are selling options. So I think the reason that fixed income vol in particular is down over the last month is that investors are saying, well, the coast is clear for the next couple months, let's call it. We need to take advantage. We've got low yields. Let's sell vol for that reason. It's not so much the Fed stepping in and counteracting the effect of mortgage hedging. I think that's a bigger long-term factor, but not so much in the last month.
Let's keep this debate going. Mike Schumacher, Barry Knapp, and we've got to get more from Mandy Zhu at Credit Suisse on getting that cyclical exposure in this equity market. Futures this morning, down about a third on the Russell. Tough time yesterday there for the small caps. The S&P 500, -6 now, down a little more than 0.1% with your movers. Here's Abby.
John, well, super small moves at the index level, but beneath the surface, we certainly have some movers, especially for the auto space. If we take a look at the shares of Tesla, they are popping higher. This on the news that their China shipments for the month of August exceeded expectations, climbing sharply, up 34.3% on a month-over-month basis. Ford had been higher earlier, still up a little bit, up 0.2% after they hired the Apple car chief. This, of course, was a Bloomberg exclusive yesterday. This is also a former Tesla executive, so folks like that add to Ford. Stellantis, on the other hand, down almost 0.9%. They lost a China investor, and NIO, the China electric vehicle company, is selling $2 billion worth of U.S. ADR, weighing on that stock and the possibility of dilution. Now, you were just mentioning the cyclical trade. Take a look at energy yesterday, down in a big way with oil today. We have oil recovering to some degree, helping out the big oil names Exxon Mobil and especially Occidental Petroleum up 1.3%. Interesting, though, yesterday, John, as you know, rates had backed up. The banks didn't do so well. Today we have rates coming back in, and it is weighing on banks. So that reflation trade is split on the morning.
Abby, thank you. Thank you very much. A target update over at Bank of America. Should you keep dancing if the music slows down? The S&P 500 target for 2021, it goes up from 3,800 to 4,250 by year end, still implying downside into year end of some 6%. And they launch a 22 year end target of 4,600, just 2% from here. So it's an upgrade to the target at Bank of America. But let's be clear, it's still a pretty bearish outlook from B of A and the team led by Savita Subramaniam. The title of the research piece coming out just moments ago, should you keep dancing if the music slows down? It's an upgrade to the target to 4,250 from 3,800 on the S&P. Coming up, the President of the United States addressing the aftermath of Hurricane Ida and stressing the need for more infrastructure spending. More on that next. From New York, this is Bloomberg.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at the frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is code red. The nation and the world are in peril. That's not hyperbole. That is a fact. These disasters aren't going to stop. They're only going to come with more frequency and ferocity. And I said, I'm working in Congress to pass two important pieces of legislation. My Build Back Better plan with key investments in to fight climate change, cutting emissions, and make things more resilient.
The president sounding the alarm on climate change in New York, pushing his Build Back Better agenda in the wake of Hurricane Ida. This coming as lawmakers prepare to debate the $3.5 trillion spending plan, with Democrats unveiling their latest proposals to expand the social safety net. For more, let's head to D.C. and catch up with Emily Wilkins. Morning, Emily.
Morning. Well, we got some more details yesterday from House Democrats on exactly what they want to be included in this $3.5 trillion reconciliation package. Giant asterisk to that is that it could be less than $3.5 trillion. These are things that are all going to be worked out in the coming weeks, but we are getting more details on things such as what Democrats want to see with Medicare expansion, with dental, with vision, with hearing, what they want to see as far as helping out child care workers with additional funding, funding, as well as the 12 weeks for universal paid leave. And one other aspect that really popped out yesterday to a number of people was a proposal that would require companies to enroll their workers in 401ks. So instead of the worker opting in, the company would do so automatically for eligible workers as a way to sort of curb off a looming retirement crisis.
Emily Wilkins, thank you. Got to build on the debt ceiling debate as well. Mike Schumacher, you've got to take on that. Look to T-bills. What's happening right now, Mike?
Yeah, it's funny, John. The T-bill market really is doing next to nothing. There's been a lot of discussion about, oh, the 3-month bill is taking a hit or the 2-month bill. We're talking about differences of maybe 2 basis points between the, let's say, bill maturing in early November, November 2nd versus late October. That's nothing. If you go to prior crises, you've got to have 10, 20 basis point differentials before things really get bad. So a lot of people are saying, oh, it's time to get in. Well, it's not. And if you look at T-bills as the canary in the coal mine, they're still alive and singing pretty well. So you've got to wait for a while. The market is not priced yet, in our view, for the debt ceiling to really get tight.
We've got policy risk on both sides of the policymakers' agenda down in D.C. For the Fed on a monetary policy side of things, for the government, for the administration on the fiscal policy side of things. Mandy, take a listen to what Morgan Stanley had to say. They dropped equities to underweight, and it's this line here. You and I talked about it.
Okay, guys, we closed position on Bitcoin, and we made 500 pounds. Okay, great. Let's move on. Let's see what else will bring us today. Speak to you later.
To the people who are concerned about policy risk in the near term.
I mean, absolutely, and investors are focused on it, and it is priced in. That's what I would say. On the upside, however, you talk about policy risk. There is policy risk to the upside. I think a lot of investors are not really focused on the fiscal package that is being discussed in Congress. I mean, it is going to be very hard to get it passed given the narrow majority that the Democrats have. But if it's something it does come along, if that does get passed, I think that's going to be the catalyst to drive a resurgence in the reflation trade. And the fact that it's not priced in, you can see that, for example, in the volatility of the cyclical sectors, right? Implied volatility of financials, energy, a lot of the cyclical sectors currently at or near 1-year low. So I think from a risk reward perspective, everyone's, putting on hedges, everyone's looking at the downside. If you look at, investor performance, a lot of people are lagging the S&P quite a bit. So going into year end, we do think there is a potential for a chase in the market. And if you think, some of the policy risks to the upside could play out, both monetary and fiscal policy, then I think looking at the upside in the cyclical sectors is the best risk reward trade here.
Let's talk about how to play that with a little bit more detail in just a moment. Mandy Zhu sticking with us alongside Michael Schumacher and Barry Knapp. Coming up, the morning calls, and later, a bear on Wall Street becomes a little less bearish on Wall Street. We'll talk about that Bank of America call in just a moment. From New York City, this is Bloomberg.
Neptune was discovered, everyone wanted to do it because it was this clear demonstration that you can use math to discover objects.
Unfortunately, since then, no major planet in our solar system has been found. But thanks to modern telescopes, thousands of smaller objects have been discovered in the past few decades beyond Neptune, called trans-Neptunian objects, or TNOs. And planetary scientists at the California Institute of Technology have noticed some anomalies with these objects. Their hypothesis? A giant theoretical planet beyond Neptune, Planet 9. And thanks to a new telescope, equipped with the largest digital camera ever built, we may be one sky survey away from finally finding it.
Crypto, you have a world of young people that want their own financial system. and their own culture. And it is very powerful, and I'm a big believer in it.
About 5 minutes away from the opening bell in New York City this Wednesday morning. Good morning to you all. It's a quiet start to the morning. Equity futures negative about 1/10% on the S&P. The small caps in trouble yesterday. We add to that. We shave another 0.2%. Call it 1/4% off the Russell. The Nasdaq down by 0.06%. We'll talk about the strength of some of those big tech players a little bit later in the program. That's the price action. Let's get you some morning calls this morning. We start first up with JP Morgan raising Netflix price target to 705 from 625. The analyst citing its strong content slate in the second half of the year. We're negative about 0.1% there after an 8-day winning streak on Netflix. 605.81. Your second call from Goldman downgrading Universal Group. The analyst seeing increasing pressure in the inpatient psychiatric labor market. We're down there by a little more than 2%, 151.89. And your third and final call from Cowen raising its price target on Chipotle to 22.50 from 2080, the analyst raising his same-store sales estimates based on the company's higher margin profile. We inch a little bit higher there by 0.5%. They're three of the calls. Up next, an equity bear getting a little less bearish as Bank of America raises its S&P 500 price target and introduces one for next year too. That conversation's still ahead. From New York City this morning, good morning. Futures negative, just 0.1%. Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report. The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Where are are we? About 22 seconds away from the opening bell in New York City. Good morning to you all. Record high on the NASDAQ coming into Wednesday this morning. Futures just a bit softer on a Russell. The small caps again taking it on the chin. We're down about 1/3 on the NASDAQ. Negative by not even a 10 on the S&P. We're down 7, negative 0.15%. That's the price action. Switch on the board. After the opening bell, we go to the bond market. Yields in all morning by a couple of basis points to 135.29 on 10s. Outside of that, a weaker euro going into the ECB, 118.14, a negative 0.2%. And crude doing okay, 69.61. We're up by 1.8%. That's the cross-asset story at the market desk with your movers. Here's Abby.
John, let's stick with that crude story because we do have oil up sharply after 2 down days, falling 2% on Tuesday and last Friday. Today, though, oil higher as traders really weigh the risks between the virus and then the supply issues around Ida. You can see today, though, the bulls are winning out. As for supply chain issues, this is sort of interesting, John. GM is down ever so slightly. It had been down more so in the pre-market. This on battery supply issues, but bigger supply chain issues showing up for the likes of Sherwin-Williams. Shares had been sharply lower. Now I suspect that they are more flat, but that they cut their outlook, their third quarter outlook on materials issues and supply constraints. And Pulte Home really down sharply, down more than 5%. They trimmed their guidance, having a hard time, John, finding materials to build homes, therefore having to cut guidance.
Abby, thank you. About a minute into the session, let's work through it together. Abby talked about the energy story, top of the power this morning, advancing 0.6%. That's where your outperformance is. All securities, the S&P 500, negative a little more than 0.1%. Some mild price action here. Real estate, negative about 0.5%. Materials down 0.4. Industrials off by 1/3. Broadly, it's an equity market in negative territory. For Bank of America and Savita Subramaniam, it's an upgrade to their price target to 42.50 from 3,800, launching a 22-year end price target of 4,600. So it's downside for this year. They're still looking for that, and they indicate just 2% from their year-end price target for this year onto next year. They're looking for 4,600. Here's the quote. Euphoric sentiment, margin risk, record duration pose additional risks. For more on this, let's bring in Kaylee Lines. Hey, Kaylee.
Hey, John. Well, I guess we could call this a capitulation on the part of Savita Subramanian and the team, but again, they are still bearish. 42.50, and we ended yesterday at 45.20. And of course, it's not the only shop that has had to make adjustments as this equity market has powered on. Just recently, Chris Harvey over at Wells Fargo went from 38.50 to 4,800. So that is a much bigger jump. You also have the likes of Brian Belsky upgrading their target in recent weeks. Of course, what a lot of the bears are flagging, Barry Bannister over at Stifel, I would mention, is the only person still down at 3,800 is the risk to the recovery. And of course, with the Delta variant, that becomes all too more in the forefront. And the question is what you want to own in that kind of environment. Now, of course, cyclical stocks have been outperforming from 2020 through to now. That index is up about 50% over that time period, whereas the defensive counterpart is up only about 40%. But that has started to change in recent weeks. You are starting to see a tilt toward defensiveness in this equity market, in that investors are flooding into higher growth names. The S&P Growth Index up about 1.7% over the last 2 weeks. The value counterpart down 1.2%. And the market-weighted S&P 500 is outperforming that of the equal-weighted one. And of course, that is because of the mega caps. The NYSE FANG Plus Index hitting an all-time high yesterday. And of course, this comes back to what Savita Subramanian is talking about, John. She's really worried about margin pressure, but you also have to consider the decelerating earnings growth. Yes, still growth, but at a slower pace. We just came out of a blockbuster second quarter, basically corporate profits doubling, but by the fourth quarter, that growth is only expected to be about 20%, John.
Kelly, thank you. Kelly Lines there on some of the calls, and Kelly, thank you very much. Looking at Savita, I think it's hard to say that Savita is capitulating this morning. As Kelly indicated, they're still looking for downside this year, just not so much downside. But what we are seeing more broadly, as Kelly also indicated, is that the bears are becoming either less bearish or outright capitulating. Chris Harvey of Wells Fargo being one over the last couple of weeks, as Kelly indicated, 4,800 year end on his price target. JP Morgan looking for more of the same, looking for more gains. They write the following: one should stay bullish on the market direction. Investor sentiment is much more subdued than it was at the start of the year, which is good. Keep using any periods of weakness to add to risk. Mandy, I want to return to you. We spent the last 20 minutes, 25 minutes talking about your reasons for taking on that additional cyclical risk. What do you say to those that are worried about chasing this market?
I think the way you do it is through these limited risk upside structures that we like. You know, for example, buying call spreads. So, no, to the point, like I agree, there's a lot of growing macro risk uncertainty out there, and it's not our core position to be overweight the cyclical sectors. We still like, for example, the secular growers like tech. But in terms of, going into the year end with everyone focused on potential downside risk,